Welcome to Hedge Fund Tips with Tom Hayes. I'm Tom Hayes, and this is your 356th VideoCast podcast for the week ending August 13th, 2026. Got a lot of incredible stuff to cover today, but as always, family first. Got a lot of great stuff. Mimi, Annabelle, and Caitlin spent the week at the Pan-Pacific Swimming Championships, which featured top Olympic swimmers from 22 countries. Mimi and Caitlin enjoyed watching the events from the excellent seats on the deck, while Annabelle worked behind the scenes at the meet. Annabelle has had an incredible experience getting a firsthand look at the action among swimming legends. Her highlights included testing cameras for the network, basket carrying for the Olympians, doing a demo for endless pools, helping present gold medals to Katie Ledecky and the world record-setting mixed medley relay team, meeting Michael Phelps and gold medal Mel, owner of Swim, and she had an amazing time and someday hopes to compete as an athlete at Pan Pacs. So here's the picture of Annabelle with Michael Phelps. Pretty awesome photo. Then you've got her, I guess, testing out the blocks, which is pretty cool with her fellow teammates. And what else? I guess that's some gold medal action there. There's Caitlin and Mimi and Major Coach and so on. And then we finished out the third leg of our vacation was in the Hamptons. There's that famous windmill in East Hampton. Incredible time. There's me and Mimi in Sag Harbor. What else have we got here? That's from we rented a house out there in Southampton. That's the fireworks. That's some friends at business networking dinner and friends and clients and awesome people there. There's Michael, Min, and of course the beautiful Caitlin, my wife, that's coming back. And you can see our little doggies traveling. There's Lucky on the bottom shelf and Pepper on the top shelf there. This is my guys. We got out yesterday. Heath and Daryl and Jeff and Jesse. Awesome time in Newport. And then this was in the Hamptons. Took a boat around Sag Harbor and Southampton, which was awesome. Okay, here's the deal. Paul Smith, by the way, you guessed the restaurant last week. I don't know if I promised a shirt or a hat or whatever, but send your mailing address to info@hedgefundtips.com. We're going to send you a shirt, which is going to be incredible. Now, for this week, the first person in the comments to actually email info@hedgefundtips.com. This was my favorite golf experience ever. I want to thank John P. for hosting me, my good friend Andrew, and my good friend Robert. This is like top 3 courses in the world. So first person to email info@hedgefundtips.com. You're going to get a free Hedge Fund Tips shirt. By the way, we're going to talk about that. This is the one you're going to get either in white or black. This is from Fiore Golf. And the reason we're having these is I want to shout out to Tony Wagner, the owner of Fiore Golf, and John Miller, partner there. You can go to their website, fioregolf.com. They got a lot of cool golf gear and stuff. It's like trying to blend Italy. Fiore is like flower in Italy, and then like the California cool surfer culture. So check them out. But whoever guesses what course this is that we played, again, top few in the world, is the first one to email is going to get one of these in black or in white, based on availability, because they sent me a ton and the quality is unbelievable. So we'll do more of these contests every week. So that's that. And let's get down to it. There's another picture with Caitlin in Southampton. By the way, shout out to Joe. So I'm walking back from dinner down the street in the main strip in Southampton, and it's dark, and it's me, my wife, and two girls, and I hear this guy yell, "Hey, hedge fund tips!" And I'm like, "What the hell is going on?" And sure enough, this lovely gentleman named Joe and his lovely family, his wife and two kids, he was putting babies in the car. He's like, "Are you Tom Hayes?" I'm like, "Yeah, it's very nice to meet you." So grateful to connect just randomly in Southampton with one of our awesome audience followers of the podcast, and really had a nice chance to talk with him and his wife for a little bit and meet Caitlin and the kids and chat. So grateful for your support, and that was a lot of fun. And let's see here. I think I'm missing a few photos. Otherwise, we'll get right down to it. There we go. So this will give you a little more tip on which course it might be. I can't say publicly on the podcast, but that was literally, I think, my favorite golf experience ever. There's my buddy Andrew and my buddy Robert, and I'll give you a little more look as to what course this might be. What an unbelievable time. So that was just terrific. Okay, let's get down to business here. First thing is, I want to thank the great David Lynn for having me on his podcast. He has one of the most engaged, large, incredible audiences. We go on and he gets 120,000 views, and a lot of people get excited. This was one of the most important interviews I've done in a while, and we really went into detail on AI trade, on memory, on a lot of different things happening, and structurally why this might be a fake out and how we're thinking about it in the short term, intermediate term, and long term. You do not want to miss this one. We're going to listen in here. I would be a seller of this move. It's a dead cat bounce. And that's why you see these waterfalls like you saw in 2000, like you saw in 2022, where retail keeps buying the dip based on recency bias. Like everything went up in 1999, everything went up. And these waterfalls tend to persist for more than just a few weeks. We're moving down the spectrum towards where I'd expected we'd be towards the end of the year, which is more likely a
CPI data came out today on Wednesday, August 12th, and it is lower. Inflation is lower than the previous month. Does that mean the Fed won't raise rates later this year? We're going to find out the direction of interest rates, but more importantly, the direction of markets, with our next guest, Thomas Hayes, managing member of Great Hill Capital. Thomas correctly called the tech sell-off in July. He was on the show back in June, early June, and he said a great rotation out of leadership is going to happen. He was dead on with this call. Now he's saying that this huge rally is a dead cat bounce and that institutions are likely going to sell into this rally and dump on retail investors, which is why he's also selling as well. He's going to tell us what we should be going into instead and rotating into now. So another rotation is happening as we speak. We're going to find out what that is. Thomas, welcome back to the show. Good to see you again.
Great to be on, David. Thank you.
CPI report first, in line with expectations, 3.4% headline CPI, 2.5% core, both ticking a bit cooler in June. Futures ticked up on it, so the S&P is up about 20 basis points, NASDAQ is up about 0.5%, gold is up 1%. That was the biggest mover on my screen, and yields are slightly down. The dollar is flat. Now, I think back in June, I think you had made the contrarian call with me that by the end of the year, people who betted on a hike would probably get at least one cut. There's been 3 dissents at the last FOMC meeting for governors who wanted, I think it was 4 governors overall that wanted hikes, but 3 dissents. And as of this morning, markets are holding 62% hold, 38% hike. There hasn't been a chance of a cut for a while. Are you still anticipating some sort of impetus for a cut, Thomas?
Well, I think the consensus when we spoke in June was that there would be hikes, and I think what's evident from both the jobs numbers and the employment numbers and the inflation numbers is that the chorus of hikes, people calling for hikes, is now diminishing. And that usually precedes the chorus of cuts accelerating. We're nowhere near that yet, but I think the idea of a hike before the end of the year, which was consensus when we last spoke, is now dramatically diminished, and the idea of a cut before a hike will start to become more material in coming weeks and months. And I think some of that's going to have to do with there's a dual mandate. So one, inflation came in more tame than expected, and that's with a backdrop of relatively elevated energy prices, even though it's been fits and starts, and a generally, weakening in terms of jobs growth, employment numbers. So you have to look at both sides of the dual mandate. But you've had equity prices holding in, which has been supportive to the market, supportive to the idea that the economy is running hot. I think that as we get into fall and as we get into pre-election and we see a normal seasonality and a little bit of enthusiasm coming out of the markets, I think the possibility of cuts will be back on the table. But to talk about it on August 12th, no one sees that yet. But just as no one saw the possibility of not having a hike in June, we're moving down the spectrum towards where I'd expected we'd be towards the end of the year, which is more likely a cut, certainly no hikes. And whether it's in at the before the calendar turns or in the first quarter is kind of immaterial. No one had that view when we were talking about it.
Let's sum up inflation, and ultimately, I like to understand the relationship between inflation and how markets respond. Peak this year around 4.2% in May. Headline, I'm talking about headline CPI, and it's been coming down ever since. Now, the long end of the curve, the 10-year and the 30-year, they've been moving up since May, despite the fact that the FOMC held rates, the Fed funds rate, unchanged. So I'm wondering how inflation impacts both the short end and the long end of the curve, in other words, the yield curve right now, because it seems like the bond market, regardless of whether or not the Fed is moving, is doing the job for Kevin Warsh. And so if we have a situation where the Fed continues to not hike rates, especially if inflation continues to cool, I'm wondering if the bond vigilantes will eventually just keep raising rates beyond 5%. What do you think?
Well, we saw it with the 30-year. I think there's latitude for them to allow that in a growing economy. I think if it gets out of control, I think you'll see Besant start to get involved, and you may see an Operation Twist come into play. You've seen some recent articles in the last couple of months talking about the options that they have to act in concert. But keep in mind, Warsh's idea of setting himself up to not hike and or cut is predicated on the idea of draining liquidity from the balance sheet side and reducing the balance sheet, which has not begun in earnest under his stewardship. But I think we're going to see more about that in coming weeks and coming months, because as he adds that slowing and liquidity drain to the market, there will be more opportunities for him to substantiate the idea of cutting and bringing down rates. At the end of the day, they can refinance on the long end or on the short end. They control the short end, and their incentive is to cut, to refinance all of that, and obviously spur housing, which is 18% housing and housing related, which is 18% of GDP, and for that whole demographic of millennials and people starting housing and family formation, that's a critical factor. So. Yeah. For us, I mean, this is all entertaining talk about guessing which way rates are going to go and predicting all of that stuff. But, we just like to buy good businesses at great prices. When the price is dislocated, they're out of favor, and sell them when everyone wants them and they're in favor, and rinse and repeat. We look for doubles and triples over a few years, and that's where we focus. So, if we get the perfect prediction on rates, and we've been pretty good on that, or currencies or all that stuff, that's fine for enterprise entertainment purposes, but it really doesn't have a dramatic impact on how we make money.
Before we continue with the video, let's talk about a company that's building serious gold leverage for the long term. Our sponsor today, Stellar Gold, is sitting on 3 major Canadian projects. Tower and Colomag are among the largest undeveloped gold sites in the country. The Tower project alone could be worth $2.5 billion after tax at a $3,200 gold price assumption. And if prices go higher, so does its value. Colomag spans over 1,000 square kilometers of greenstone deposits and could be Canada's next big gold camp. They also have Hollinger Tailings, a cleanup project that could deliver near-term cash flow. Across all projects, they've drilled over 16 million ounces of gold, which would cost over $2 billion to replicate today. With a seasoned team, Stellar Gold is one company to watch. Scan the QR code here on screen or visit stellargold.com/David Lin to learn more. We'll get your outlook on sectors you like and dislike in just a minute. I think where I was going with these rates is that equities investors don't like higher rates. And
Correct.
I was wondering if this is an opportunity to sell off. Now, the counter argument here is that the yen intervention that we saw a week and a half ago by Scott Bessent in the Treasury, that can be interpreted as extremely bullish for equities, because what the Fed is basically, what the government is basically signaling with this move is that they're willing to engage in some sort of yield control, maybe not directly, but the logic here is buying the yen with backstop or prevent the Japanese from selling off a lot of treasuries, which would push yields even higher. So indirect yield control, they're going to do whatever it takes to prevent interest rates from going up. Remember, Trump and his administration do not want higher interest rates.
Correct.
So this is an incredibly bullish move. What do you think?
I agree with you 100%. I think that the trend prospectively, and now you can see the alignment between the Japanese and the U.S. is that the yen will either naturally or through some intervention stabilize and or actually appreciate relative to the U.S. dollar over the next couple of years. I would continue to play, despite the short-term counter trend move, I would continue to play weaker dollar over the coming couple of years and stronger yen. So as we've seen, whether it's going to happen naturally or in markets, or if the authorities are going to intervene, that trend will be intact. And we've already seen the early stages of the carry trade. I wouldn't call it an unwind, but a mitigation of the carry trade, and that's been part of the reason for the underperformance. If you remember a year ago when we were on your show, lighten up on the Mag 7. It was predicated on a number of factors, but one of them was the carry trade unwind, and the Mag 7 has become the Lag 7 and underperformed. And then on June we said get out of semis. Now, I think this move in the last couple of weeks. Look, there's canaries in the coal mine. Okay. You don't get a month with this type of leverage. AI-related exposure to leverage ETFs now has jumped from 26% to 58% in the last couple of years. Major hedge funds, these are not amateur hour folks. Whale Rock down 21.7% in the month of July. Lone Pine, 27%. Altimeter, down 11% in the month of July. Situational awareness, which everyone knows, down 67% in the month of July. Vara hedge fund down 44%, not in 1 month. So there is a lot of leverage that's coming out of this. And what people are mistaken is there were a lot of people that got aggressively short in the hole, and now you're seeing this violent counter trend move in the last couple of weeks. And I would be a seller of this move. And people will say, well, how could you be a seller of this move when you just saw CoreWeave's earnings, and you saw Nebius's earnings, and you saw, Taiwan Semiconductor saying that demand is insatiable, and Micron and all these guys. And the answer is because that's known. So what you have not seen revenue growth or earnings expectations at levels this high, 15% revenue growth since Q4 of 2021. Okay. And we all know although people have a short memory, we all know what happened in 2022, right after earnings expectations were at all-time highs and revenue growth was at the highest rate in history. Is you had a cooling of the tech sector. Venture capital blew up. You had all the, ARK blew up. All the tech funds blew up. The tech sector had a correction, a refresh in 2022. And I think what people are mistaken for a rally in semiconductors and memory, number one, none of them have made new highs, by the way. Most of them, if you look at the charts, which I sent you about 50 of them, it's a dead cat bounce. And I think what you're going to see, this is normal seasonality. I think you're going to see into, maybe the third, fourth week of August, this dead cat bounce. But retail investors are now chasing this short covering move off the lows, 20, 30% on stocks that had fallen, in the month of July alone, 30 to in some cases, 55, 60%. So now retail's all amped up and buying, one-day options and call options, and there's a little bit of gamma squeeze going. But institutions who got caught with their pants down in July, which there's a lot more than just Whale Rock, Lone Pine, Altimeter, Situational, and Vara, that this is just the canary in the coal mine. They are using this quote unquote strength or dead cat bounce to get out. And that's why you see these waterfalls like you saw in 2000, like you saw in 2022, where retail keeps buying the dip based on recency bias. Like in 2021, everything went up. In 1999, everything went up. And these waterfalls tend to persist for more than just a few weeks. The dead cat bounces are sold for multiple weeks, if not multiple months, which leads me to the point that we're not generally bearish on the AI thesis. We think we're mid-innings, but the return on investment is going to show up much later. I mean, we're not even seeing the bump that we should be seeing in productivity. Productivity hasn't improved despite all of this investment. All that we're seeing is Mag 7, hyperscalers exhaust all of their free cash flow and now raise debt and now raise equity. Like you're seeing Intel diluted their shareholders by 20 some odd percent. Google did that offering, and the ducks are quacking, so they're going to feed them. And in line with that, we're seeing record equity issuance. At some point, when you keep issuing equity, the supply overwhelms demand, and I think we're going to see the effects of that in the next couple of 2-3 months headed into the election, as you get this final bout of everyone calling new all-time highs. You'll see the calls for 8,000, 9,000, get retail all back into the boat after they got flushed in July. And once everyone's back in, pull out the trapdoor into the election. And that's where we'll be aggressively buying this trade when people say the AI trade's over, there's no return on investment. And when that's consensus, and some of these semiconductors are down, another 30%, we'll be swooping in to build our long-term list.
Before we talk about that, I want to revisit your June call. This was a rather prescient call. So people should check out our last interview with Thomas in early June. June 2nd was the air date. And you were talking about how a leadership in stocks, bonds, but particularly in the tech space, that leadership is going to rotate. And that was a spot-on call, because right after that in July, as you pointed out already, the semis and several other sectors, but particularly the semis, had a waterfall moment, 24% down from the peak. And now, as you said, the violent dead cat bounce. What were the signs back in June that leadership is about to start rotating, Thomas? If you had to recap your, jot a memory for us.
Yeah, there were a lot of things. I mean, number one, it's first off, you got to look at positioning, and retail call buying and concentrated call buying in the semiconductor was at record all-time highs. So it was insatiable, and all the demand was coming in. Most crowded trade in the world, what is semiconductors? It still is, by the way, semiconductors and memory, which is part of the reason we think it's going to weaken a little bit here in coming months. There was euphoria, and we're seeing very similar patterns on this dead cat bounce, which is also going to wind up punishing. You cannot have a situation where all these major institutions got hit that hard. Look, every single one of these guys that's down 21, 27, 11, 67, 44 in the month of July, first thing that they got on August 1st was redemption requests. So what they're going to have to do is create liquidity in coming months. But these are not emotional retail people who sell in the hole or buy after 30% rallies. These are guys that are going to wait for the dead cat bounces to create the liquidity that they need to meet the redemption requests. And that's coming to a theater near you in coming weeks. So unlike June, where after the gamma squeeze was over and all the options. So when dealers sell these options to retail and people chasing up at the top, and you had this parabolic move off the lows in April in the semiconductor trade, the dealers have to buy the underlying stock to hedge out their risk. And that creates that kind of crescendo parabolic final move. This situation is different. You're now seeing, after this 20-30% dead cat bounce, you're seeing all the retail folks jump back in leveraged ETFs, in buying calls on the semiconductor, buying it on memory, and justifying it with the recency bias of the earnings. These are all known. The market is a discounting mechanism. So the smart institutions who got caught with their pants down in July are going to use this strength created by the exuberant retail class who has a short-term memory and use that liquidity to get the hell out and raise some cash to meet their redemptions, and to maybe buy at lower levels in the fall with the money that they have left. And that's what's going to surprise people. And for the next week, and by the way, we were out publicly a week and a half ago. We were in New York, and we said, everyone was bearish on semis. I said, listen, thanks for the credit on the call, but we're going to probably get a violent rip here. We're going to be sellers of this rip.
Okay, if you're sellers of that,
had turned from excessively bullish in June to excessively bearish after July, and usually there's no sellers left. That's when you get these violent dead cat bounces, as you referenced, which should be faded.
If you're a seller of this dead cat bounce, then what are you putting your money into?
I think what you want to do and you started to see a taste of it in July, that trade is going to continue. What dramatically outperformed for us, and what we were talking about with you in June, is get out of semis and get into defensives. So you want to bet on the consumer. But what's unique about this situation is, I think not only do you want to bet on defensives like consumer staples, I also believe you want to bet on defensives like consumer discretionary, because consumer confidence is finally starting to bounce off multi-decade and in some cases all-time lows that were reached just a few months ago. Consumer confidence is starting to turn up. So I think you want a barbell of the theme is bet on the consumer. The barbell is bet on it in a defensive way and in an optimistic way, aka consumer staples on the defensive side, which will do well if we get some weakness and fall into the election, and consumer discretionary, because the consumer has been counted out. And you never want to bet against the U.S. consumer when they have a job. And with 4% unemployment rate, even though job growth is slowing, they do have jobs and their consumer confidence is turning up. And so long as energy prices stay in this kind of range of 70 to 90, they're in good shape and they will be spending. And I think the flush is pretty multi-decade extreme. Certainly the flush in defensives relative to the S&P is like a 25-year generational buy opportunity in terms of consumer discretionary relative to the S&P 500. It may be the best time in about 10 years, not 25 years. So half generational opportunity. And that's where the opportunity is. I think I would be easing up out of this AI trade in the short term. I would be easing into or aggressively moving into defensive consumer and offensive consumer, aka consumer staples and consumer discretionary. Bet on the U.S. consumer here.
If someone were to ask you, why are you both cyclically inclined and also on the defensive? So you got consumer cyclicals and defensive. How would you answer that?
I think both are washed out. So what you've seen in July is a dramatic move in a lot of these defensive stocks, whether it was healthcare. As a matter of fact, there was a good article in Bloomberg yesterday that long healthcare is the new short AI trade. And then they showed how healthcare has dramatically outperformed the AI trade in the previous 6 weeks, et cetera. We also have healthcare exposure for that particular reason. For simplicity, I'm talking about the consumer, but I would say a barbell of defensives, aka healthcare, consumer staples, not so much utilities, because that's kind of gotten a backdraft of being part of the AI trade. So I would leave that part out. Healthcare and defenses for sure, and consumer staples is offense, because that sector has been completely flushed out in the face of AI. And part of the reason for that has been the Iran tensions, the prices of oil, the inflation expectations. You know, it's funny, you mentioned inflation coming down. I mean, 5-year inflation break-evens have stayed relatively contained given the risks that have been created with the Iran situation. And in that context, and I think that's part of the reason you're seeing the consumer start to regain their confidence. I mean, you couldn't believe the divergence between the equity markets and consumer confidence may be at a record wide. Like, we couldn't quite understand why the consumer was so pessimistic in all these surveys when the economy is doing generally well, the stock market's doing generally well. And I think the fear was there was a lot of people worried about $120 and $150 oil, and consumer sentiment is directly tied to their expectations about inflation in the future. And I think on that first time when Trump was out saying, look, we're going to get a deal, and when we get a deal, oil's going to plummet, and then they saw oil plummet on the perception of a deal several months back, many were surprised by that. And I think what it told them is, like, there is an element of this taco trade that things will only get so bad before it's walked back or pull out or a deal signed or whatever. And on that basis, the consumer in general is feeling a little bit more confident about inflation expectations. The other thing that you're seeing is two of the big components of inflation that had been so sticky and painful for years post-COVID had been insurance premiums, which really hits everyone hard. Those are softening. The insurance premiums and the insurance industry is softening against all consensus that it ever would. And owner's equivalent rent and rents are stabilizing and coming down. So those are two key components that had really dramatically hurt the consumer, which are no longer quite as painful. And in the context of inflation, 5-year inflation expectations being contained and people feeling more confident in consumer confidence, I think you have to have some offensive. You know, if you look at restaurants have been flushed out, a lot of the consumer discretionary items, whether it's clothing, et cetera. I think back to school is going to be relatively stronger than expectations. And that's only because the bar is so low and people are so pessimistic about the consumer. We love to be buying when no one's interested in these groups. And when they're at 10-year relative lows in the case of discretionary and 25-year relative lows in the case of defensives, we want to be backing up the truck.
How much of the last quarter's good earnings was a result of Trump's tariff refunds? How significant are the refunds to their bottom lines and EPS, do you think?
It certainly played a factor. Most companies were pretty explicit in their calls on the impact of the tariffs. What I thought was really interesting in the case of a few companies we own is that we do a lot of turnarounds, and turnarounds are often reluctant to do a lot of buybacks because they want to use all available capital to reinvest in the turnaround strategy and reinvest in growth, et cetera. But we have one company called Dentsply Sirona, which is defensive, which is healthcare. They do largest supplier of dental supplies since the late 1800s. It's a GDP growing business. The stock had been hit due to bad management, et cetera. And they used a good slug of their refund for buying back stock in the hole. Yeah. And I think you're seeing, watch what people say, but watch what they do is more important. And a lot of these companies in consumer discretionary, you can't give away the stock. And some of the defensives were using those refunds to buy in stock because they felt that their stock was cheap. Whereas on the flip side, with some of the AI companies, you're seeing more selling from the inside than buying. Certainly equity issuance versus equity recapture. I mean, you've seen all the charts about buybacks declining among the companies that had been historically the premier buyers of their own stock. They can no longer afford to do so, the hyperscalers, because they're free cash flow negative. And that's not expected to inflect or start to turn up until the late 27, early 28. And that's predicated on, we hope and expect that we'll start to see a return on invested capital. There's no explicit signs of that yet. And honestly, everything else other than an increase in the productivity rate is noise. So if they're saying, we're going to get this, we're going to get that. And if you look at productivity numbers every month not going up, then there's no return on invested capital yet for the investment in AI. It's like we all have, and that might just be a function of the investment creating better models that actually start to do things better, et cetera. And we'll get there, and it will be like a hockey stick move. But we're all using AI, and it saves us time, and it does all this stuff that is great. But can you really say that you're more productive per minute, and it's led to more increase in your bottom line in the last 12 months because of the use relative to the amount that you've spent on it? And in some sense, you've been subsidized in the early days because they're, getting you hooked on the product like every good drug dealer. It's like, we'll give it to you for free. And then like a year from now, they're going to start charging you for it. And the answer, I think, for a lot of people is, and particularly large companies, they were kind of shocked by their token expense, which is what has led to the interest in the open weight model, because you can, get this capacity for, 1/10 the cost, in some cases 1/100th of the cost. But, the first thing was, we got to use AI, we got to use, unlimited tokens. Then they got the bill and they didn't see a return for that bill. And then they started saying, we need other alternatives. So the answer to the question is, I think as they move more and more to cheaper models, they'll start to get a better return. But a lot of this AI trade is predicated on the two frontier models succeeding, OpenAI and Anthropic. So if there are models that you can get for 1/10 or 1/100th of the cost, they've got 1.5 trillion in unfunded commitments related to those two companies. And then you look at other earnings from all the people holding the stock in Anthropic and OpenAI. So they're dependent on them in terms of revenues as a customer, but those companies don't have the income to fund the commitments of CapEx that they've put out there, which the entire finance industry is relying upon. So the answer to your question is, like, the indicator to watch whether this is all going to work out in time to substantiate all the investment that's going in on the basis that it is going to work out in time, aka the return will come before the bill comes due, is productivity growth. And there are no signs that all of this investment has led to any productivity growth Yet we're all betting, or people that are crowded into the AI trade are all betting that productivity increases. If productivity doesn't increase, it's all for naught. And then you wind up with a 2000 situation where we, as the consumer, 5 years out, will be better off for it. But all the people that invested in it, like the Global Crossings, like the MCI WorldComs, et cetera, they'll be in trouble because they can't pay the bill, but we'll get the benefit for the bill that they paid without paying any out of pocket. So ultimately, we'll have a better standard of living 5 years from now if the robots don't kill us all. But the good news is we're not paying for it directly. The question is, will the payers of this see the return or not? And right now, consensus in this dead cat bounce is, of course they will. The demand is insatiable, but the demand will only stay insatiable to the extent that there is a return, and productivity growth will tell you whether or not there's returns. And so far, the answer is no. I'm of the camp that the answer will be yes, but it will take another 18 to 24 months. And there will be a point in time during that period where people stop believing that the return will come before the bill comes due, and that will be the time to buy the AI trade.
And investors are scrutinizing when and if the AI CapEx build out is going to slow down even just a tiny bit, because that's become such an embedded assumption. AI CapEx growth, and any indicator of slowing down may be a sentiment indicator overall for slower growth in the AI sector. Take a look at this story that was released just 2 days ago. NVIDIA and AI compute, $500 billion of third-party capital. NVIDIA today announced strategic partnerships to establish independent compute financing platforms with Apollo, BlackRock, Blackstone, Brookfield, Goldman Sachs, and KKR to mobilize over $500 billion of third-party capital for the build-out of AI infrastructure over time. This is just a short statement from Jensen Huang, CEO. In AI, compute is revenue. NVIDIA compute is uniquely suited for this role. It is broadly adopted, flexible across models and workloads, fungible and transferable across customers and operators, and continuously improved through CUDA software. That is why we are bringing the world's leading long-term capital providers together to independently underwrite AI infrastructure. These financing platforms will help customers access scarce compute at scale and build the DSX AI factories that will power every industry and country in the age of AI. I had to bring this up because you're talking about issuing equity. What do they need to when they have kind of deals like this? What's going on? Because I'm not really sure what the structure of this $500 billion third-party capital is.
Yeah, what's going on is it's back to the future. I mean, securitizing an asset is not something new, okay? You've done it from legacy music albums, okay, where you have a stream of income from the music that gets played over, and the the creative artist says, okay, I don't want the recurring, I want a lump sum now, and Wall Street will securitize that. You had it with housing as it relates to mortgage. That was a productive asset until it wasn't, and it didn't work. This is all going to be, the problem with this type of securitization is, when you lend on a house and the person doesn't pay, the real problem in 2007, 2008 is that, they were basically doing 100% financing in some cases, or 10% financing on inflated values. So when you got the house back, you kind of didn't want it because the house was worth less than what you lent on the house. If you're thinking on the side of the lenders that got screwed and why it brought down the whole financial system. Autos is a similar situation. Credit cards is a similar situation because those are all tied to people performing, or you get the asset back, or you have a lawsuit. In the case of lending on effectively data centers, let's just get to the brass tacks of it, semiconductors, Jensen is strongly trying to make the case that the useful life of these assets is more than 5 years. And the reason he has to make that case is because the success of this $500 billion is going to be solely predicated on convincing the rating agencies to put investment grade ratings on this so they can stuff all the insurance companies and all the retail investors full of this product. Okay. And the problem is in normal lending, if you don't get paid, you take the asset, you take the manufacturing company, you take the factory line, you take the inventory, you take the house in the case of a mortgage. In this case, what are you going to take? You're going to take a semiconductor chip that is 5 years outdated and already has significant use on it and may be obsolete in whether it's 3 years if technology advances, or maybe it's 7 years if Jensen's case is right. But the issue is, if you don't get paid back, you're basically not secured by anything useful. And that's what's concerning about what they're doing. The problem is, or the opportunity is, depending which side you're on, is that people aren't going to figure this out until 5 years from now when they realize they lent on something that's not secure. So it's a manana problem. And the five guys at the table who are coming in from the Hamptons in the middle of August to do this meeting, which tells you the urgency of it, because they've realized this whole entire thesis has now run out of financing if we don't create another source of financing, is they say, basically, we can do this all over and we won't get hurt because we're just going to collect fees brokering the securitization and laying it off to institutions and retail investors, provided we can convince the credit rating agencies that this is a secure asset, which it's not. And the fact that they're all sitting at the table tells us that they think that that's the case. And the rating agency's incentive is to agree with them because they're going to get insane amounts of fees by rating this quote unquote new asset class. This conversation clip will not be useful for us to refer back to 3 months from now, but it will be very useful for us to refer back to 3 to 5 years from now.
One more question on the AI build out. So Google, this is what you were talking about earlier. We're referencing, this is issuing equity, right? Google raised $85 billion, or upsized its equity capital to $85 billion from $80 billion. It's now the largest largest raise in U.S. corporate history. They're going to use it to fund the AI infrastructure and global compute build out. Now, at what point do investors think too much CapEx is bad for the valuation of the stock? That was the case for SpaceX when their latest earnings revealed that they beat revenue expectations by a tremendous margin, but they spent way too much money on stuff that had nothing to do with their core business, AI for Grok, and investors didn't like that, and the stock went down. And so at a certain point, investors are going to start asking themselves whether or not, like you mentioned, this CapEx is productive. You're a fund manager. What are some of the signs you're looking for if you're going to go parse through the 10K or 10Q to see whether or not they spent $85 billion productively?
Well, look, the results in the short term have shown you that it's a bad use of capital. Okay. Now, what the market is betting on, and the market is a discounting mechanism, is that mañana is going to be a brighter day. And I'm kind of in that camp. I just think that the runway to that brighter day is a bit longer than the market thinks it's going to be right now. And in that, so if you look at the semiconductor trade in the last big generational tech run-up from 1995 to 2000, during that period, there were three 50% drawdowns in the semiconductor, the SOX index, from 1995 through 2000. So all of the things that the internet revolution promised were delivered times 10. The issue was you were paying in 2000 as if all of it had already been delivered, which is why many people that crowded into the tech trade at the end or even before the end wound up with nothing, because the NASDAQ then subsequently corrected 80-90%. even though everything people were betting on happened, they had just paid as if it had already happened, but it wouldn't actually happen until 10 or 15 years later in some cases. And I think that's kind of what you're seeing now, is people are paying as if the returns will definitely come, and they're going to get impatient in coming quarters or sooner when they find out it's going to take longer than expected, or they've already paid for it. And even though it's coming, they've overpaid for that result. And at that point, there's going to come a time, David, I don't know if it's in the next few weeks or the next few months or the next couple of years, where people will be despondent about the AI trade, and we will only be halfway through, and that will be your opportunity to buy one of those 50% drawdowns like we saw from 95 to 2000 in the semiconductor index. So this is, there's nothing new under the sun. This have repeated throughout history, and even if this is not like a 2000 top, which we believe it is not, there will be pain along the way onto that final parabolic move, at which time, whether that's 5 or 7 years out, when people realize the emperor has no clothes and they've securitized, hundreds of billions, if not trillions of dollars by then, secured by something that has no value. We'll worry about that later. But that's not a today story. That's a down the road story. But it's the same game played all different again. New wrapper, and the ratings agencies will be initially reluctant because of what happened to them during the housing crisis. But eventually they'll be pressured because they'll want the fees and they'll want the earnings, and everything will look fine. Productivity will be increasing, and then all of a sudden, when it slows and they're not cash flowing the way, and they lent on depreciating assets. It's one thing to loan on real estate. Real estate goes up you cannot make a case for me. It's like if I lend on a house that's overvalued today, and I get it wrong, and the housing corrects 20%, it's still a productive asset. And 15 years from now, if I got to take it back, I'm going to probably make money when I liquidate the thing. You cannot make the case if I lend on a 2026 vintage NVIDIA GPU that in 7 years, it's going to be worth more than it's worth today, and I'm going to get my money back. Like, you can't, you cannot, they're going to sell that bullshit story, but it ain't going to be true. I can tell you that 100%, bet the bank on it.
Okay. Well, let's see in 7 years. I mean, I'm probably in agreement with you. Final question before we go. You mentioned earlier, right? Your business is picking good businesses. That's what you do as a fund manager. Are there any, again, this is a long-term story here. Are there any businesses or types of businesses or sectors, entire sectors that you think will no longer be good businesses in 5 to 7 years because AI will make them borderline obsolete? And these are trends that people follow and should invest on.
What I'm spending all my day on is finding businesses that AI will be beneficiaries of AI and not disintermediated by AI. So look, I have a value tilt. I like turnarounds. You can't help but notice the carnage in software. And I cannot, I look at the price relative to free cash flow, what it's cash flowing today. And honestly, every time I go to do something in software, I'm like, I just can't be damn certain this is not going to be fully disintermediated 5 years from now. I think if you put a gun to my head, I'd probably tell you that it's probably not as bad as people think it is right now. And some of these guys, some of these are generational buys, but it has to go in my too hard box because I'm a investor, not a psychic. So, right. Software, as much as I want to buy these things like crazy, I can't be 100% certain that I'm not going to have capital impairment. So on the flip side, I can tell you one thing, AI is going to help businesses like Diageo, which is a leading purveyor of high-end spirits and Guinness beer, and it's not going to be disintermediated unless AI can figure out a way to help you forget all of your troubles, that's better than, having a cocktail with a friend at a sports match because they were a huge sponsor of the World Cup and Guinness was flowing everywhere. I think, if anything, AI is going to help them increase margins over time. And that's what Drastic Dave, the new CEO who came from Tesco, Dave Lewis, and Unilever has done. He has cost discipline. He's done many turnarounds in brand management. He's applying the same principles to Diageo. Look, Diageo was cut in half. I mean, during COVID, people were paid to sit home, get money, and drink alcohol. Okay, after that, they said, okay, now we're out of the house. Oh, there are these things called GLP-1s. Now we want to be healthy and lose all the weight that we gained during COVID. Problem with GLP-1s is, so far the data says that 85% of the people that get on it are off of it within 2 years. So whether that's cost or side effects or just, entropy or whatever, people don't stick with it as much as one would think that they would want to stick with it based on the results that, we see that they deliver in all the scientific studies. And Diageo traded down 50% off of its 2021 highs, still generating $3 billion in free cash flow. And by the way, growing double digits everywhere in the world, whether it's Africa, whether it's Europe, South America, et cetera. The only place that it's really struggled, which has hurt the stock, has been the U.S. has a tequila problem. Okay. And, there's the country song, tequila makes her clothes fall off. Well, in the case of Diageo, tequila makes her earnings fall off. And they're fixing that. They're getting it resolved with Drastic Dave, and it's starting to inflect. It's generating, billions of free cash flow. It's trading like it's going out of business. So that's, where we want to have money invested. It had a 13.4% return on invested capital for fiscal year 2026. So we don't have to worry about getting our money back like we do with some of the other trades. And we're buying it with a large enough margin of safety, even if the new baseline is lower than it was at the COVID peak. People are drinking less. What is the case is, while it may be true that people are drinking less, they're drinking better. And Diageo is the premier high-end spirits category purveyor in the world, 1.4 times revenue of its second largest competitor. So we like that as a safe play, because when you're going to get your fits and starts, just as you did from 95 to 2000, where the semiconductors corrected 50% 3 times, you're going to get more of those. And when those things happen, people look for a place to hide. And they don't have to worry about hiding in something like Diageo, down 50% of its all-time highs, generating that type of cash. And yes, you can look at the chart and just see what's happened to it since July. I mean, it's moved from like the 70s to 100 in a minute. Now it's resting because the dead cat bounce in AI. Everyone's cramming back into AI short term. When that rolls back over, Diageo takes its next leg higher. So we love that trade. We love the long-term free cash flow. We love the return on invested capital. We love the new jockey, which is critical in a turnaround with Drastic Dave Lewis. And we think there's a lot of upside there. And then the second thing, so that's defensive consumer. Now, where's offensive consumer? I think it's Disney. And you had mentioned my vacation earlier. I was able to take with my family. We went to France, and we had a day to kill coming off the red eye. We went to Euro Disney, and just like all the U.S. parks, it was completely packed. And they had a whole new branch of the park there, which was Frozen. If you go to the parks in the US, it's all the same old stuff, Space Mountain and everything else. Now they're adding Avatar. But in Europe, they had just finished the whole new Frozen thing, which is the huge franchise for the young kids. Park was packed. Everything was great. And the good news is the new CEO, Josh D'Amaro, comes from the experiences side of the business in Disney, which had the highest return on invested capital for many, many years. And that's where they're allocating all their resources moving forward. So streaming had been a drag. Now it's free cash flow positive, growing. The entertainment's doing fine. Live sports, ESPN, everyone had written it off for nothing. Now they're saying, well, this is pretty valuable. They're crushing it in the box office, and they're investing in the experiences, new cruise ships, new investment into the parks, and I loved it. Everyone thought Disney was going to do poorly on earnings because Universal's parks were crap. But guess what? Universal's was crap. Disney was up. Disney is the key. Everyone loves it. It's a cultural phenomenon, and they're expanding all over the world in experiences. And they're putting the money now continually in the highest return on capital businesses. So this is a cheap long-term play. This happens every 15, 20 years. The stock sells off 50%. Everyone says it's over. And then they realize, oh my gosh, they have the greatest IP library in the history of mankind, and they find new ways to monetize it. In the 80s, they went from, movie theaters to VHS. That was a huge monetization period that lasted 2 decades. Now they've gone from DVD to streaming. First, it was a huge investment, low return on invested capital. Now it's starting to cash flow positive, and the parks have just been a long-term staple, and the cruise business has been a monster. So we're excited about Disney because price is what you pay, value is what you get. Good business at great prices, and that's what Diageo and Disney are. So you want to be in consumer discretionary on the offensive consumer staples, and healthcare on being defensive. And when you have the fits and starts and the AI trade backs up, these groups are going to do just fine, and in many cases, exceptional.
Buy tequila companies, don't drink it yourself during trading, I think is the takeaway there. Thank you so much. You've gave us a lot of tips now, Thomas. We appreciate that. Where can we go to follow you for more tips?
Yeah. So look, our day job is we run money for ultra high net worth and family offices. That's greathillcapital.com. We do a free blog every week. We talk about 2 of our holdings and go into analysis at hedgefundtips.com. And we're known pretty well for our podcast, Hedge Fund Tips with Tom Hayes. You can find on YouTube or anywhere you get your podcast. It's top in the hedge fund category, which is a narrow category, but we're happy about that for people who like to invest on the basis of fundamentals, knowing what you're paying for. Price is what you pay, value is what you get. If you want to invest on price and the flavor of the month, that's other podcasts where you'll get tremendous value. But if you want, we've always just tried to buy good businesses, turnaround situations that can double or triple in 3 to 5 years. And that provides a high RRR to compound and double capital and multiply capital over the long term. That's what we're good at. And we hope we can be helpful to you.
All right. Appreciate it. We'll put the links down below. So check out Great Hill Capital and also Hedge Fund Tips. Great website. Thank you so much, Thomas. Good to see you again.
Thank you, David.
Thank you for watching. Please do like and subscribe. Follow Thomas. Links down below.
And we're back. And then I had the chance to do an abbreviated version of that with Scott Shellady on his show on RFD Network, which caters to Midwestern farmers. Pretty much every farmer in the country listens to Scott Shellady's show. These are business people that have incredible businesses, and was grateful to speak with them. So we're going to listen in here.
All right, welcome back. My next guest, he's a pretty smart guy, right? He's a Columbia grad, for Pete's sake, right? He sent us some great notes overnight with his macro outlook into this economy and these markets. And he says this: at the end of the last year, he told his audience and his customers to lighten up on the Mag 7. He says they've since become, I love this, the Lag 7 and underperformed. That's a really good moniker. So that really caught my eye. In June, he told his clients to sell semiconductors and anything memory, as it was the most crowded trade on the block or in the world. And he was proven right, as most of them dropped about 25 to 50% in July. You remember that. I felt it. I still had some on board. He says this is going to continue in fits and starts through the fall. Sell the rips, he says, in semis and memory again, but for now. I think all those were great tidbits, and I wanted him on for more of that. Those are great quips, so let's bring him on, right? Please welcome to the show, Thomas Hayes. He's the chairman and managing member of Great Hill Capital out in California. Thanks for being on, brother. Really appreciate what you had to say. Why don't you expand for us? We got a CPI number today. Maybe you can start there. I don't care if you want to talk about it. We've been talking about it all morning, but then give everybody your kind of little synopsis of what you think is going to play out here for the last 5 months of the year.
Yeah, Scott, thanks for having me on. Always great to be back. CPI, came in a little bit less than expected. We've been in the camp about a month and a half ago. It was consensus that we were going to get hikes. We said we would bet more on cuts. I think the truth is going to be somewhere in the middle where we get hold through the end of the year. But if you put a gun to my head and said, are we getting a hike or a cut? I think more inclined to get a cut. Inflation, despite Iran, is staying contained. Jobs growth is slowing a little bit. There is a dual mandate. And we're still in the camp of a cut, whether that comes before the turn of the calendar year or after the turn of the calendar year, is beyond me. But I will say that that's kind of where we're headed. As it relates to consumer confidence has turned up as a result of inflation being more subdued, and the fact that they can kind of keep it contained in spite of what happened in Iran tells you what you need to know about inflation. The interesting thing is the pain points had been insurance premiums and owner's equivalent rent. And, everyone thought insurance premiums were going to stay elevated forever. They're starting to come in. You're seeing that in the insurance industry. You're seeing pockets of weakness in real estate through some of the states that grew the fastest through COVID. So I think this is all positive, and seeing consumer confidence come off of many year, if not all-time lows as a result of inflation expectations being contained is a positive thing for Main Street. But I know you want to get to what are we going to talk about with Wall Street in coming months?
Well, I mean, look, I'll bring up Wall Street, but probably not how you thought I was going to bring it up. I mean, I agree wholeheartedly with your rate outlook. I think it's a little, I don't know. I can't believe we're actually talking about cuts, but there's some smart people that are. So I want you to put on your thinking cap, because I Googled this again, or I researched it again about Moynihan and all of his lackeys over at Bank of America. They have not climbed down from their 325 basis point hikes going into the end of the year. They're still in that camp as of yesterday. I don't know if they've changed that as of this morning, but they still see hikes. Now, I don't know if they're looking at something, maybe they got different colored lenses on than I do, but I think that would be pretty steep. What say you?
My general view is, we tend to do very well buying stocks that analysts sell side downgrades in the hole, and selling stocks that analysts can't get enough of. So look, if they had the crystal ball that everyone thinks they have on the sell side, they'd be on the buy side making 10 times as much money, managing money. So you take it with a grain of salt. There's some incredible analysts on the sell side. I do like Hartnett over at Bank of America Merrill Lynch, but he has kind of a different view than some of the other pockets of the Bank of America sell side. So I'd keep an open mind there, but 3 cuts, I mean, I'll take that all day long. If they want to sell that in a securitized product, I'll take the other side. And we do pretty well on taking no 3 cuts is completely out of the 3 hikes is completely out of the question in the anywhere in the intermediate near term to 12-month time frame.
All right, now people are they're looking always for the next downdraft, right? Where the next rug pull is going to come on. You said a great line about the lag 7 instead of mag 7. I might actually steal that. That's a great line. But at the same time, could we get another kind of a nervous market going into the midterms? What are your expectations there?
Yeah, we're cautious here, Scott. A couple of things. You're seeing the same type of enthusiasm again on memory and semiconductors and the AI trade that you saw in June, before some of these semiconductors and memory rolled over 35, 50, some even 60, 65%. The thing to keep in mind is who are the buyers and who are the buyers and who are the sellers. In July alone, you had, I know Leonardo was the headline with situational awareness, ironic title, down 67% for the month because he was levered long AI and memory trades. But it wasn't just situational awareness. You had major players that are older than 25 years old, seasoned guys, get absolutely taken out to the woodshed. Whale Rock down 21%, Lone Pine down 27%, Altimeter 11%, Vara down 44% in 1 month. And it's not to point them out, it's to point out the context of what's happening. And what's happening is this. A lot of people got caught with their pants down in July. And the retail is getting sucked back in, buying options and leveraged ETF exposure has gone from 26% to 58% in the levered ETFs on the AI trade. And that's all retail jumping back in after this 30% dead cat bounce. I'm telling you, doing this for so long, all these guys that got caught with their pants down, it's the most crowded trade in the world, Bank of America Fund Manager Survey, are not going to be using this dead cat short covering rally to jump in 30% up. They're going to be using it to get the hell out. They've got one more chance, because when you have a down 27 or 67 or 44% month, the first thing you get on April 1st that these guys received were redemption notices. And they have to get liquidity to service those redemption notices. And they're going to do so in taking advantage of the liquidity that retail is providing, buying this dead cat bounce, the short sellers covering their shorts in the short term. The shorts are going to re-put out their shorts. You're seeing it across some of the big names, et cetera, that were right in July. But the folks that think because earnings were good on the quote unquote AI trade, that this is a new rally to new highs, are going to be mistaken, because institutions are going to be selling the rip in this trade. And I think this will probably bottom out on an intermediate term basis sometime closer to the election. So sell this strength in AI and memory, and there'll be better chances to buy. We don't think that this is 2000 or it's the end of the AI trade. We do think there are going to be better opportunities to buy it in the fifth inning at much lower prices.
That's awesome stuff, as usual. That's why we have you on, man. I appreciate everything. I hope folks listen to what you had to say there. That's Thomas Hayes. He's with Great Hill Capital, Newport Beach, California. Thanks for coming on.
And we're back. Thanks to Scott. And quotes of the week: investment students need only 2 well-taught courses. First, how to value a business. And second, how to think about market prices. That's from Warren Buffett. You can get most of that in The Intelligent Investor by Ben Graham, which was Warren Buffett's favorite book. And then the rest of it is through 20 or 30 years of experience in going through cycles. But other than that, easy peasy. Peter Lynch: investing without research is like playing stud poker and never looking at the cards. We have a lot of those shenanigans happening right now, and people thinking that they've got an edge when they're mistaken luck for skill, and sooner or later the casino will call in those chits and they'll be giving it back. As a matter of fact, I was telling a story last night to a group of very successful business people, of a guy who put in basically a very small amount of money, less than $1 million, into a very famous, I'm not going to get into detail about the brand because I don't want people to reverse engineer it, into a very famous vodka brand. This must be about 10 years ago. And he turned like less than $1 million into $200 million. And I saw, so it was a startup, and he made like a couple hundred out of it. And I was on the East Coast, and I happened to see like a real estate high-end magazine, and I remember the house that this person bought was like, 15,000 square feet, indoor tennis court, indoor pool, indoor basketball court, all the blah blah blah. And I was like, so I called a couple friends. I'm like, hey, why is so and so selling? Da 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 da. Me, like, yeah, I like buying distress. Anyway, so they're like, oh yeah, he got into like a bunch of illiquid privates that didn't turn out, and da 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 da, and he's got a liquidity issue. And look, the long and the short of it is, he got lucky, and rather than leave the casino, he stayed for the free drinks, and he gave all the chips back. And I think we're going to see a lot of that with what's happened with memory and semis and some parts of the AI trade over time. But the key here is what Peter Lynch said: know what you own, know why you own it. Price is what you pay, value is what you get. If you're paying, people are like, but look at all the earnings. Yeah, but the market is a discounting mechanism that is priced in. The question is, Are you paying for all the goodness that's going to come 5 and 10 years hence today? And if so, you may be buying a great business at a terrible price. What we try to do and teach on this podcast is to buy good businesses at great prices, make our doubles and triples over a few years, rinse and repeat. So let's get down to that agenda, and want to first off acknowledge all the people who have been sharing this podcast with their friends and family. That's why we continue to grow. That's why we continue to do it every week. And a lot of you find it easiest, rather than just call someone up or email a friend or family and say, hey, you should check out this podcast. I've gotten a lot of value, blah, blah, blah. They wear the merch, whether it's the hat, the shirts, the hoodies or whatever. And people ask them, and we continue to grow. And that's why we do it for clients, which we'll do forever, every week. But non-clients alike, because you guys have done your part. And specifically want to acknowledge the people who have not only supported it by wearing the merch and sharing the podcast, but sending in your photos so you can be part of the community here. And I want to acknowledge Devin Dalberg for sending in his photo in that awesome Hedge Fund Tips hoodie. That's my favorite product, by the way. We're not yet in winter, but we're moving there. And Scott Dickinson on the golf course with his awesome Hedge Fund Tips hat. Those are the two newbies. And you can go see all the awesome folks over the weeks that have been sending that in. So please do so yourself. Now, we went into a lot of detail with David Lynn, but we also referenced like, hey, we had sent you a bunch of charts as well. So I want to go through these charts and update you on what's been happening and the quote unquote dead cat bounce and short covering that I'm talking about. And, you know, the other important thing is this. You know, we do expect some pre-election weakness and some midterm election year weak seasonality into September and October. And we have so the way to dampen volatility is to have some shorts. And we do have a position which we've had hedging out those areas that we think, if we're correct about pre-election weakness, what could we be in that would get the most amount of return for the least amount of equity, to have a couple percent in. So if the market pulls back, 8, 10, 12%, this group falls a lot more than that. And therefore, having a hedge of 1 or 2% plus with an expected value of 5 or 7x would dampen the volatility and give us a lot of cash to buy stuff, in October into the year-end rally. And this is not what people mistake a hedge for. They think it's a trade that I'm predicting when, and that's not what it is. Hedges can and should expire worthless. That's the goal, because that means it did not happen. Your insurance policy, like no one buys an insurance policy because they want their house to burn down. They buy an insurance policy hoping that the house doesn't burn down. The key is to be prepared in the event that it does, and to actually profit from it. And that's why we want to have that hedge on the most crowded trade that will give us the best return for a very small amount of capital with some leverage on it to take advantage if, in fact, the house does get a little bit of fire in the kitchen that gets put out, right after the election. But our goal is not to make 7x on the hedge, because that would mean, most of the stuff is having a short-term mark-to-market. The goal is that it expires worthless, which means everything else continues to go up. But if we're going to get a short-term impairment, we want to be in a position to take advantage of it and to create more money to buy the lows, so that when all is said and done and you have the year-end rally, you wind up with even more returns than you would have if the pullback never came. So that's the framework around specific hedges that I have, whereas people view them as trades, which is not an accurate assessment. Otherwise, it would be a big position of 5 or 10 or 15% of equity, which certainly is not the case. So we're prepared for all eventualities, but it is tracking as anticipated. If you recall from a couple weeks ago, when everyone was bearish on semiconductors at the turn of the month because they've just fallen 25 to, depending on the name, 60%. We said, yeah, well, that's the good news. The bad news is you're going to get a rip your face. You're going to get a dead cat bounce here and sell the rip. And I think we're at that sell the rip point. People are all getting giddy, as we covered with Scott. Retail is buying options again, very short-term memory. And what would negate all of this is if this dead cat bounce turned to new highs. And what we're seeing in the AI memory trade, the most crowded trade that we referenced in both interviews, is that it has not. Okay. Now, if it invalidates it and it makes new highs, so be it. It means everything else in the portfolio is going up. I mean, today you had PayPal over $60, which invalidates the idea that $60.50 offer would be tenable, and it more confirms our desire that they run the playbook and run this thing over $100 over the next few years, which would be incredible for us, or at the very least, don't accept anything minus an 8 handle on an offer, etc. So we'll cover some of that. But let's just go through these names so you can visually see. And if you're listening to the podcast this week, I would go to YouTube, type in Hedge Fund Tips with Tom Hayes, go to episode 356, and view this so you understand what I'm talking about. Because if you just watch, Fox Business or Bloomberg or CNBC, all you hear about is the enthusiasm, but you want to burden yourself with what's actually happening. And here is AEIS. You could see here dropped, a third, dead cat bounce up to the 50-day moving average. And, this should be the area in coming days or a couple of weeks, because you should have strength into mid to late August before the weakness begins, where this is where institutions will be unloading. This is where retail's buying back. And you can see it across the board. These are not making new highs. These are dead cat bounces, and this is what we call a waterfall. And I think there's going to be more selling into the fall. Now, if it was a trade, it would be a 10 to 15% position with a lot of leverage. If it's a hedge, it would be a 2 to 2.5% position that we hope it expires worthless. But if it doesn't, we make 5 to 7x, which adds 14% of performance that we can use that cash to buy stuff up into the year end and wind up with even more returns at the top. So that is the framework for how we think about that, not to be mistaken with day trading gamblers trying to predict short-term moves. Applied Materials, same story. Look, dead cat bounce. You would think that this is at new highs, nowhere even close. AMD, and you have to put it in context of what we discussed about just the handful of funds that publicly we talked about the results, but there are dozens of them that now have to create this liquidity that got shellacked with their pants down in July. AMD, same story, nowhere near new highs. AMKR, same story, dropped more than 55, 60%. It's only bounced about 20%, dropped from 96 to 42, bounced to 55. This is not going to new highs anytime soon. This is in waterfall mode. Same with even ASML, which is the top of the heap in terms of quality, dropped 25%, has bounced, retraced about 50, half of that, and looks like it's stalling. Same with ASX, same with Bloom Energy, which is another AI trade, dropped 50%, more than 50%, and is barely probably retraced 38% of that. Caterpillar, which was an AI trade, you can't make this stuff up, dropped 25%, has barely maybe bounced 10%. Sienna, okay, this thing was left for dead for 20 years, dropped 50%, has retraced less than a third of that. Cisco, okay, Cisco was the one that was worrying. I'm like, well, if Cisco makes new highs, because it had dropped about 25%, and then bounced more than 50% of that loss up to, so 129 to 107 to 124, and then they reported last night, and boom, they're down 7%. So this is that waterfall of lower highs. This is probably going to break down even more. Corning, another one left for dead for 30 years, crashed more than 60%, has only retraced probably about 30% of that move. Looks like it's stalling to roll over. Intel, same story. You couldn't give away Intel at $19, and they sold $20 billion of stock at $100 to the Johnny-come-latelys. And when the ducks are quacking, feed them. They just got diluted by 20%. People are going to do the math over the weekend, and this thing's going a lot lower. It goes to 60 before it goes to 200, if it ever does. Lam Research, same story, 43 down to 250. Again, these are not new highs. The market is making new highs. This most crowded trade is still in a waterfall. We expect more pain. Lam, Lattice Semiconductor, same exact story. Bouncing up against that 50-day, going to roll back over. On this chart, I think it's at 36. Who cares? It's the same nonsense. MKSI, 444 to 256. Now, bouncing just barely. It hardly bounced, and that'll probably roll over with more pain. Marvell, same story. So, ladies and gentlemen, do not get sucked into this dead cat bounce is our view. Institutions are going to use this to create the liquidity that they got caught with their pants down in July. And, situational awareness and the poster boy are only it's a symbol of what's happening, but there's widespread pain under the surface that most of you are not seeing that led to many, many redemption requests. And the liquidity will be created through the strength of the short covering and the dead cat bounce and the slight gamma squeeze from the retail. Same with Micron, 1,200 down to 700, barely bounced up to 900. RMBS, cut in half. It's barely bounced off of that. I think expect more weakness. SMT, Semtech, same type of story. Dropped, basically from 177 down to 100. It's bounced up to 140. Looks like it's stalling out. Expected to go lower. This is what's going to surprise people into the fall. Everyone's getting exuberant again, and I think it's at the exact wrong time. Teradyne, same story. Fell a lot. Bounced. Looks like it's stalling out here for the next phase of the waterfall. We shall see. Taiwan Semiconductor, TTMI. I mean, it over and over. So you burden yourself with the facts. VICR, cut in half, barely bounced, stalling out. What do they call this? A bearish cross, the technicians. VRT. These things are broken. Western Digital, etc. So something to keep in mind there. The Slumer stuff, let's just get a quick overview. Market's up to 7,800 strong, and that's a function of more and more participation. We saw it with a massive July month was unbelievable for us. And what do we got here? Advanced decline line, that's showing more and more participation, which is what we've called for. Equal weight outperforming cap weighted, which is what we've been calling for. Small caps breaking out, participating now. And that's been a theme, international over time, over U.S. value versus growth, and small cap versus large cap in coming years. Europe breaking out to new highs before the U.S. did. Tokyo is moving. Hong Kong, a laggard, but looking to test new highs and break through there. That's going to be where you get the most bang for your buck in terms of value over the next couple of years in our view. Here are the 30 and 10-year yields bumping up against these highs. I think this is a fake out that will roll over into the fall as yields compress, just as the dollar strength was a counter trend fake out, and this line will be broken, and they will continue. The dollar will continue its downtrend, and the Canadian dollar, the loonies, started to see the strength in the last couple of years as we anticipated. A little pullback to fake everyone out. It's going higher, and it's going to work above these levels over time. The Canadians are going to be smiling so wide they could eat a banana sideways. Oil came down off these million deal promises. Gold, dead cat bounce. This will probably roll back over. I know everyone's excited about that because it's very hard to hold two conflicting thoughts in mind at the same time, aka dollar weakens over time and the gold top is in. But it's happened many times in history. Copper, the doctorate in economics is showing us global economy is strong, demand for copper is high, and so on. So what else do we have here? Semiconductors. Here's the dead cat bounce, bumping up against 12,782 on the SOX. It's probably there now, and that's probably the resistance until we see further weakness. Netflix. No, we're not doing anything there, but I could see why people are attracted to it. McDonald's. Oh my goodness. We had McDonald's in France one day for lunch, and it was a crowded branch. It was right by the Louvre, and it was the most horrible experience we'd ever had. I mean, we're not really McDonald's people, but we needed something quick, and it was like a hockey puck with a bunch of salt dumped. You could literally see the salt dumped on it. I hope that was a one-off, but McDonald's on this pullback looks interesting, but after that experience, I'm like, man, I don't know, something's going on there. Maybe the CEO with his tiny little bite has not tried the burgers in France, the hockey pucks with a spoonful of salt on them. It's mind-boggling. And I like salt, by the way. Don't get me wrong. I mean, I'll put salt on everything. This was crazy town. Blackstone. Okay, so we got some of these here. All right, we're done with this one for now. Thanks for my friends over there for sending that out. On the dot-com boom, only the dot-com boom pushed U.S. valuations higher than they are today. So you can see here, Schiller cyclically adjusted price-to-earnings ratio for U.S. stocks. We're not in the camp. This is another 2,000, but we do think there's going to be further weakness in that most crowded trade. But you can see, I mean, you got to go way back to see this type of elevated. So I think there could be some material pain in that sector, which albeit is a good portion of the market. But I also think that the rest of the market could pick up the baton because Main Street is doing quite well. Healthcare has become a covert tech semiconductor short. You see here this from Wall Street Journal with healthcare dramatically outperforming semis in the last 6 weeks. That's a call that we made here many times on Hedge Fund Tips with Tom Hayes. U.S. stock valuations have never been higher. Trailing PE, forward PE, CAPE, price to book, price to sales, enterprise value to E. So when you say stocks, they're talking about an index, but the index now is all skewed to the AI trade, 40% of the weighting. And you can see higher than the dot-com bubble when you account for all these metrics, and the highest since 1929. These are some of the funds that we were talking about between Altimeter and Whale Rock and Situational Awareness and Vara. That got completely slacked. And here's an example of style drift. The Vara one is a value-aligned research advisors. Well, how were they down 44% in 1 month? The answer is they shifted away from what their advertising is their framework toward chasing shiny objects. And that happens to the best of them, and it doesn't end well. AI-related exposure in leveraged ETFs has gone way up from 26 to 58%. These are not times you want to be a buyer. This is times you want to sell. The dead cat bounces. Trading leveraged ETFs have surged. Retail can't get enough. Bank of America bull and bear indicator at 9.7. So this is what you see near peaks. It's at extreme. This is the most important chart that we're going to cover this week, in my opinion. It shows the S&P cycle composite for 2026, accounting for midterm election year, accounting for all the blended factors going from 1928 through now, which implies that we should get this kind of blow off strength into the third week of August. And then the pain will begin as people come back from vacation, September, late August through early to mid-October, flushing everyone out before the election. It'll feel like a crash, even if it's only 8 or 10 or 12%, and then year-end rally. So we wanted to have a foothold there. If that plays out, that 2% equity exposure, that fire insurance will give us a lot of capital to buy more stuff. But the other thing you have to keep in mind is as all these were selling off in July, our names were ripping because we were in those things that ripping higher because we were in the defensives and the things that do well when those rip out. So we could have two bites in the apple. One is our hedge works and creates more capital, and two is the rest of the portfolio is going up, which is what we saw in spades in July. So that's how we're positioned for it. And if this doesn't happen, that would be great. We would love our insurance to expire without a fire, which means everything else is doing great. So that's the right way to think about framework. Call option volume. Some people think if you have a hedge, it's like, oh my gosh, I've paid all these insurance premiums for the last 12 months and my house hasn't been on fire. Let's get out the gasoline. I mean, come on, guys, you're crazy town. All right. That's not the way you want your to get the value from your insurance policy. It's called a hedge. Call option volume, and there's your epic buying panic blow off. Yesterday, over 4 million S&P call options were bought, the highest level ever recorded, and we know how that ends. Russell 1000 growth versus Russell 1000 value. Growth has dramatically underperformed this year. S&P token prices rolling over. This is one of the things we've been talking. People are moving from the closed weight. And by the way, the whole AI trade is predicated, if you think about the circular financing, on Anthropic and OpenAI doing great. And if CFOs, the CEOs went out a few quarters ago and said, we got to get AI, go full bore on AI. And then next quarter, the CFOs are like, we're going to miss our numbers. Like, we're spending so much and we're not getting a return. So then they said, well, you got to find a cheaper way to do it. So now all the folks that said we can't do China open weight because of security are now saying do China open weight because we want to keep doing AI, but we want to get a return, so the costs have to be lower. And if that's true, there's a lot of unfunded liabilities that are predicated on the CapEx spend coming from OpenAI and from Anthropic that may not come to pass if all of the demand goes to these open weight models and then the whole entire house of cards unravels. That's kind of like the apocalyptic scenario. I think the truth will lie somewhere in between, but I don't think that where this is priced right now is justified relative to what the reality will be in the next 2 years. I think following the next 2 years, I think we will see a return on invested capital. The question is, who are going to be the purveyors that create that return on invested capital? And the lower the cost, the higher return. And so far, Anthropic and OpenAI are not showing any competitive model that could compete on price. They could certainly compete on efficacy, but they cannot compete on price at the moment. And if they do start to have to compete on price, there's a lot of debt and unfunded commitments that are tied to it that are not going to be money good. Billions of SpaceX shares set to unlock over the next year. Money for nothing. Total returns for the past 10 years. Dividend index, okay. Tech sector, by the way, this is the time to buy a dividend index in case you're paying attention. Tech sector outperformance over time, it runs in cycles. Uncannily, forecast CapEx relative to revenue for calendar year 2026. So Meta's looking at 55% of revenue. This is kind of a useless chart. It should be relative to cash flow, and we all know cash flows are going negative. When profits surge, no one cuts payrolls. For your presidential election midterm, weak spot is Q3, Q2, and Q3, and then the sweet spot is Q4. So that would start in mid to late October. Should be the bottom, and the weakness should be starting in coming weeks. We shall see if it plays out according to script. Hyperscalers CapEx rising through 2028, but pace of CapEx growth starts slowing in first half of 2027. The market is a discounting mechanism that will start to sniff that out 6 to 12 months ahead, and when people recognize the deceleration in the growth rate, they don't get out slowly, they get out all at once, like fire in a theater. While hyperscalers free cash flow inflection should be closer to second half of 2027. So you can see negative free cash flow for at least 6 more quarters and probably not seeing the return on investment until sometime in 2028. So somewhere in this period, people are going to blink and say the AI trade is over. We will be buying amongst the rubble and catching this inflection when you actually do start to see the return towards the end of the decade. Strong growth without other income. That's the mark to market, but there is 50% of the gains have been due to investment gains. More than 50%. So of the 50.9% growth, 28% is the mark to market on Anthropic and AI, which may not prove to be realizable over time. What else do we have here? Revenue growth. This I referenced, actually. This is the first time you've seen it since Q4 of 2021. We all know what happened next. That was peak. And then in Q1 through Q3 of 2022, you had a massive cool off in the tech sector with the S&P down over 20%. CEO confidence rising back. I think the non-AI trade is surprising a lot of people, and I think that's where you want to be putting your money for the foreseeable next few quarters. Equal weight is ahead for the first time in years. We called that here. 80% of stocks grew EPS year on year in Q2, a 94th percentile quarter. A lot of good stuff happening outside the most crowded trade. Pagar atención for my Latino friends. Not nominal sales growth and sales growth adjusted for inflation and FX are rising at the fastest pace since 2021. It's a key year that we keep referencing back. We've referenced long-term themes back to 2001 to 2004, short-term themes to 2022. Pagar atención. Maybe we'll get a hat that says Pagar atención. Hedge fund tips con Tomas Haas. All right. Bulls that get to 3 usually last many more years. We agree with that. S&P revenue growth. Energy has been humming. Compliments of Iran. Very few recessions start in the year of the presidential cycle, meaning this year. We agree with that. We don't see a recession on the horizon at any point in the near future. Okay, let's put call. Annual equity issuance. This is something to pay attention to. The ducks are quacking. Feed them. Intel just fed them. Google just fed them. More are going to try to feed them. Meta. And we have not seen this type of equity issuance since when? The end of 2021. We know what happened next. Supply overwhelms demand, and it's clear how that plays out. Earnings revisions, dividend yield lowest since 2000. That was the time to be buying those boring stocks. As Buffett was when everyone said, has Warren Buffett lost his touch? And then he went on, while people were losing 80 and 90% of their money in the NASDAQ, he went on to have 3 or 4 of his best performing years in a long time because he was buying the Procter & Gamble's and the Coca-Colas and the Disney and the boring stuff that no one wanted at that time. Wage growth is outpacing home price inflation for the first time in a while. That's good to see. Tech sector funds. AUM, ETF flows in AUM. This is peak type of euphoria. Can't get enough. They're feeding them, and that won't end well. Ecosystem capital flows. Here's the circular financing model. We know how that will play out. Emerging market stocks trade at record discounts to the S&P 500. There's your opportunity. A lot of great stuff in China. We have through Baba. We were fortunate to get some for new clients below 100. And I think still very, very cheap at these levels, going a lot higher over time. That's going to be your value play. And Alibaba owns a ton of these cheaper open weight type model companies because they've given them compute in exchange to equity over the years. While hedge funds exposure to cyclicals versus defensives is at an all-time high, almost 5 standard deviations above the long-term average, which tells you what do you want to own? You want to own defensives, and we've been pounding the table on that. Margin debt as a percentage of market cap, market value, starting to approach great financial crisis levels. We shall see. Difference in card spend growth between upper and lower income households. Leveraged ETF AUM. Sure, this will end well. Concentrated in semis. That is going to get shellacked. This was the warning shot that people ignored in July. ETF net inflows, strongest pace in history. S&P call volumes, record. That will not end well. Those people are not going to get paid. The dealers will. It's tough to be a bear these days. We agree. We've got fully invested, 10% margin, and we have our fire insurance in place in case we get a little bit of kitchen fire. But we're standing by with the fire extinguisher ready to go with a smile in hand. Percent of companies raising guidance this season going up. Toy Story franchise cooking for Disney. Housing inventory ticking up aggressively. That's good. CMXT is now larger than Tencent in market value. That's the memory competitor to Micron and SanDisk. Midterm election year seasonal pattern. So we covered from 1928, the Ned Davis data, and it's confirmed with the Hirsch data, Yale and Jeff Hirsch, where you get this bout of strength into the end of August and then dramatic weakness into October. Percent of non-U.S. countries beating the U.S., over 50% right now. That's good to see. In terms of stock price, it just runs in cycles. It's nothing to do with patriotism or any of that stuff. America will always be better because we got the best from around the world in one place, and natural resources and open markets and et cetera. Dollar futures, here's the dead cat bounce. I think going lower over time. U.S. dollar net positioning. Everyone's long. It's going lower. Money returning to healthcare. You guys heard it here first. It took a little while, and now it's in spades. It will be the new trade here as semiconductors unwind. Healthcare sector, ETF flows. Even if you didn't want to get short or have a hedge or have fire insurance, a good way to do that would be to buy defensives, healthcare, staples, etc. Consumer discretionary weight in the S&P 500, lowest in over a decade and a half. Consumer staples, lowest in 2.5 decades. And that's why we said buy the consumer, defensive on the staples, offensive on discretionary. These are generational time periods to buy them when no one wants them. And they bet against the U.S. consumer, which is a huge mistake when they have a job and they still have jobs at a 4.1% unemployment rate. All right, and that's that for the data. I wanted to cover this interview from Patrick Kelleher on CNBC. I thought he did a phenomenal job laying out the future. We do not have enough stock in this. We need to get more. And kudos to Patrick. 5 years for GXO on a standalone, and super happy with what he's doing over there.
Welcome back. Supply chain logistics firm GXO ringing the opening bell this morning to mark the 5th anniversary of their listing here at the NYSE. The company officially completed the spinoff from former parent XPO Logistics back in 2021. And joining us now is Patrick Kelleher, who's nearing his first anniversary as GXO Logistics CEO. Welcome, Patrick. It's good to have you.
Thank you very much for having me.
So how is the logistics business going right now, and how closely does it track the overall economy?
Yeah, I think as supply chain business, we're tracking very closely with the economy. We see firsthand how our customers are filling warehouses, retracting on inventory, those types of movements. We have great visibility to demand. I think what's really unique about the visibility that we have as GXO is that we work across a diverse set of industries. We service the retail, e-commerce, CPG industries, but on the industrial side, we're in aerospace, defense, we're in technology, especially data centers, we're in life sciences, and then we're in the industrial sector. So we get a great cross-section view of what's happening in the economy across the 26 countries we operate in.
So data centers was, the magic word there that you said. How big of a business is this for you, and what's the potential?
This is a big business, and it's growing for us. We are the supply chain engine behind the build and the maintenance and sustainment of data centers. So we have our people who are building out the racks for initial construction of the data centers. And then when a part goes down at a data center, we're the ones providing the replacement part. We're doing the returns. We're doing the reclamation. We're seeing huge growth in that business with.
So your employees are actually embedded in these data centers?
We actually have separate warehouses where we actually construct the racks, and then we ship the racks into the data centers, and then we have warehouses full of the equipment that's required to keep a data center running.
I have to imagine that AI itself is helping you manage movement in ways that probably few other industries benefit as much from that, right?
Yes, I love that we're on all parts of the AI equation. We're on the data center build, helping build the capacity to run AI, and we are a big adopter of AI. We launched the tool GXO IQ last year, which is the medium for us to deploy AI to our 1,200 operations around the world. We're seeing great results from AI. Good example, we implemented an AI bot to improve picking productivity for a consumer manufacturer. We saw 50% improvement in productivity just on that. So when you think about the scale of improvement that can bring to our business for our customers, it's an incredible opportunity.
Is it mostly about the positioning of assets physically around the country?
It can be around a lot of different things. We use AI for forecasting to understand what the demand is going to be day to day, hour to hour, so we can plan our labor in the right way. We use AI to help our customers deploy inventory. We use AI to make sure that it gets processed through the warehouse in the most efficient way. So it really is end-to-end deployment of AI.
Where are you on humanoid robotics in terms of using them in your warehouses, and how do you see that evolving?
It is really exciting. I am super passionate about humanoids playing a big role in the warehouses going forward. We've done 45 pilots with 6 different providers on humanoids. We're launching another pilot in Europe this second half of this year. I think we're 2 years away from having ROI on humanoids. And we already have humanoids performing tasks in the warehouse, such as picking cosmetics or unloading trucks.
So give us the timeline to 2 years. Why that? What is it you're seeing now that you think is going to be potentially solved, I guess?
It really is about the processing speed of the humanoid. So every day we're using AI to train a humanoid. And we are training a humanoid to pick a cosmetic. They may be able to pick it at 20 units an hour, where today a human can pick it at 40. We're working to close that gap, and it is all about processing speed, processing capacity when we look at closing that gap. When we saw the news yesterday of the further investment in AI and computing capacity, I think that is a huge catalyst to making technologies like humanoids really come to life. I know that 5 years ago, the amount of coding that is done in one day today on humanoids in training could not have been done in a year. Just 5 years ago. So I think this is going to move very fastly, and that's why we're going to get to ROI.
And the market will soon recognize it. Alibaba says modular design delivers AI data centers in 100 days at 10% lower cost. That's unbelievable. Delivering an AI data center in 100 days at 10% lower cost. That's Alibaba. I love it. Alibaba tests paid AI appetite with $30 annual Office Assistant subscription. We love it. Apple says Mac users in China can connect to Alibaba's Qwen AI service. China's cheap AI is shifting investors' focus to internet stocks. Alibaba-backed AI startup Vast seeks fresh capital and eyes an IPO. We've covered that for ages. Alibaba is not only the toll taker for the Chinese middle-class consumer and the leader in cloud and compute in Asia, but they are also an AI ETF because they have equity in all the hottest startups in China and Asia. Because several years ago, when these startups needed compute, they said, no problem, we will give it to you for free. You will give us equity. And now we own equity in all of these, and it's not recognized yet in this price of the stock. It will be recognized on the first 100 and 1,000 bagger when it IPOs. And then people will be like, well, why is Alibaba trading at $250? And we'll say, go back to Hedge Fund Tips with Tom Hayes in 2023 and 2024, and we were telling you what was going to take place. Diageo boss Dave Lewis strikes revival on canned cocktails and Guinness. Diageo to double Guinness production by 2029. PayPal puts revenue targets on key units as CEO reviews strategy, giving them optionality if they want to spin off certain divisions, etc. That's probably why the stock was over $60 today. Pay your way, play your way. Venmo is now on Google Play. Disney. Well, let's see how Disney parks are bucking a travel slowdown. They're doing well. It was great to see Disney doing well while Universal parks are not doing well. It just shows the quality of the product. We experienced that in Disney Euro with the new Frozen park area, and Space Mountain was faster and smoother. You know, the ones in the US are rickety. So they're investing where they get the highest return on capital in parks, experiences, and cruises. Why Disney's next big consumer product bet is trading cards. Okay, that's the newest, latest, and greatest. Continue without upgrading. Boeing to sell 3 autonomous flight subsidiaries, so they're leaning down with Archer and they'll have equity, et cetera. Etsy to cut 12% of workforce as CEO focuses on core marketplace, which is growing the fastest. So good to see that. Some cost discipline. Canada Goose sells Baffin footwear in effort to focus operations. We'd love to see that. With EV sales slowing, hybrid cars are hot again. Hybrids are very, very good for Cooper Standard, which we're going to cover in our article of the week. They get more cost per vehicle. Asian car makers cash in as high petrol prices lift demand, U.S. demand for hybrids. Ford's new Phantom electric pickup truck will start at $28,000. Dentsply Sirona records second quarter 2026 results. If you remember, they were saying that, when the stock was down a lot, we want to invest in R&D, but at these prices, we do want to buy back stock potentially by the end of the year. Well, they didn't wait till the end of the year because they bought back $12 million of stock at $10 and change in Q2, which tells you everything you need to know of what they think of the stock price at these levels. We couldn't agree more, which is why we added a ton in. That is a nice size position. Let's just put it that way. Healthcare investing is now an AI short in disguise. That's what we were discussing in the data. Trump weighs call for capital gains tax cuts as midterm election boost. Mortgage rates finally stop rising, causing demand to trickle back. Number of stocks beating, by the way, there's so much pent-up demand. If they can just get rates down a little bit, housing is going to boom. Number of stocks beating the S&P 500 is the highest in 4 years. Why that number should rise, this is to our point. Even if the crowded trade weakens, there's so much good happening on Main Street. And ultimately, the story is not going to be return on investment for the hyperscalers. It's going to be return on utilization. Hyperscalers foot the bill. Everyday businesses like GXO and Diageo and others get the margin expansion benefit from the utilization. It wasn't the people who made money who laid the fiber like Global Crossing for the internet. It was the people who used the internet, like the software companies, like the search companies, that didn't have to pay the bill but got the benefit. How AI could live up to the hype and still leave investors disappointed. That's from Business Insider. NVIDIA confirms record $500 billion off-balance sheet SPV deal to fund the world's biggest circle jerk. That's from Zero Hedge. We agree. We discussed that in with David Lin. Intel increases the size of stock offering to raise $20 billion. Dilution for you. And the Ducks are so hungry that they're not even understanding the implications of buying at the top. So God bless them. Literally, I mean, Mr. Market, go read it in Ben Graham's Intelligent Investor. You couldn't give it away at 19, and they could sell $20 billion worth at 100. You can't make it up. You literally, if you live long enough, you see it all. For newer readers, here's an overview of the key drivers behind our thesis on Cooper Standard, a special situation auto supplier offering a leverage play on the light vehicle production recovery and the massive operating leverage that comes with it. If you recall, we initiated this position in May of 2022. We went live on the Clayman Countdown in June of 2022. Stock was $5 and change. Now it's $30, going a lot higher. And here is the core thesis. You can read it at hedgefundtips.com. While you're there, click on terms. This is all opinion, not advice. Consult your psychic, financial advisor, etc. before doing anything, or do nothing. Paying the bill before sending the invoice. If we had to sum up Cooper Standard's second quarter in a single line, that would be it. While top line revenue of $721 million, up 2.2% year on year, came in ahead of consensus of $710 million, adjusted EBITDA took input cost pressures on the chin, falling 14% to $53.9 million, and missing consensus expectations of $64.8 million. As expected, the decline came almost entirely from oil-driven hyperinflation working its way through the cost base, with higher material costs across rubber, metals, resins, creating a $10 million headwind, alongside general inflation, $8 million, and higher duties and tariffs, $8 million, with $15 million of manufacturing and purchasing lean savings absorbing what it could. None of this was a surprise. Management told us on Q1 call in plain English that the second quarter would take a hit and the back half would recover it, because that is precisely how the index-based commercial agreements are structured. With north of 70% of the exposure now covered contractually and the remainder negotiated on a rolling basis. The indices reset quarterly, meaning CPS absorbs the input cost inflation when it hits and claws it back from the customer in the period that follows. That is exactly what is now underway, with price increases going into effect across all purchase orders on July 1st. More importantly, this was the first significant test of those agreements have faced since being put in place, and they are working exactly as intended, with management noting that customers have lived up to every single deal. That is the part deserving far more attention than it is getting. A commodity shock of this magnitude used to take a permanent bite out of a leveraged supplier like Cooper Standard. Today is nothing more than a timing difference between two quarters, a fundamental de-risk that we are watching play out in real time. The market, in typical shoot first, ask questions later fashion, got a head faked by the headline, quote, miss anyway, treating Cooper Standard as a show me story. Show me the recoveries, show me the margins, show me the volumes. Meanwhile, because the recoveries are contractual rather than hoped for, management has a direct line of sight to recovering the vast majority of the cost pressures, 10 million materials, 11 million duties, and tariffs year to date in the back half. By maintaining the midpoint of the full year 280 million adjusted EBITDA plus 33% year on year growth, while hiking the low end to 265 from 260, the implied back half requires 12.6% adjusted EBITDA margins in each quarter, alongside 100 million of cumulative free cash flow in the second half. That gets Cooper Standard to its long-awaited double-digit margin target, while marking a fourth consecutive year of positive free cash flow generation. Tip of the cap to management for delivering on these targets despite a seemingly endless stream of headwinds, from tariffs and hyperinflation to war and customer supply chain disruptions. Through it all, they have continued to control what they can control. Kudos to Jeff Edwards and team. They've done amazing. Beyond this world-class execution, it's funny, I talk to the company from time to time, and investor relations are like, oh, we haven't heard from you in a while. I was like, because there's nothing to talk about. You're doing everything that you said you would do. So what am I going to add other than, just sit along for the ride? That's the value of being able to pick good jockeys. Beyond this world-class execution, the market continues to overlook three catalysts moving decisively in Cooper Standard's favor. First and foremost, new business awards. You can see them hockey sticking. This is the number one leading indicator of growth over the next 24 to 36 month window. and it's hitting another gear. Cooper Standard booked another $118 million, plus 54% year on year of net new business wins in Q2, bringing first half wins to $246 million, up 87% year over year. This accounts for 83% of all fiscal year 2025's haul in just 6 months and is running well ahead of plan against a $400 million plus full year target, levels not seen since 2019. Better yet, these wins carry far higher margins than the programs they are replacing, with management once again confirming that the company already has the capacity to launch most of them with minimal incremental capital investment, a key driver behind its expectation of tripling return on invested capital by fiscal year 2028. A solid portion of these wins, and another underappreciated point management highlighted on the call, came from conquest business. Over the past 10 months, the Fluids Group has been awarded mid-production business nearly 10 times, totaling $40 million in annual sales, effective this year, rather than on the usual 2 to 3 year ramp taken directly from a competitor buckling under the same trough conditions CPS is absorbing without a scratch. Management noted the sealing team has seen the same thing happen a couple of times over the past 12 months. This is a direct testament to the innovation and world-class execution that has become synonymous with Cooper Standard as of late, with customers clearly taking notice. The second key catalyst is hybrid vehicles. Consumers are voting with their wallets, and the mass market is making itself clear. Hybrids are winning. Hybrid sales are up 20.5% year to date and now account for 15.4% of all new vehicles sold, gaining 2.9% percentage points in share in a single year and making hybrids the fastest growing powertrain in the country. Just as importantly, consideration has reached an all-time high, with 22% of shoppers considering a new hybrid in the first half, up from 20% a year earlier. Elevated gas prices have only amplified the trend, with 56% of in-market shoppers saying rising prices at the pump make them more likely to consider a hybrid or plug-in hybrid. That's from Cox Automotive. OEMs are taking notice. Analysts now see hybrids accounting for as much as 40% of global vehicle production by 2030, while the U.S. hybrid powertrain mix is expected to nearly double to 27% of sales over the next 5 years. If you remember, our original thesis back in 2022 was predicated on ICE sales, which don't make nearly as much money per vehicle as hybrid sales. So we're getting this additional tailwind. Ford, CPS number one consumer, 27% of sales, put it plainly, quote, "Hybrids are another strength for Ford we plan to build on. The F-150 hybrid leads among full-size trucks, and the Maverick hybrid achieved record sales in the first half to become America's best-selling hybrid pickup. We plan to extend our hybrids across our entire lineup for the next several years." Toyota has gone even further, with the U.S. head of product planning stating that, quote, "For all the vehicles we are developing, the base assumption right now is that it should be 100% hybrid." By the way, it was interesting. Toyota Motor Corp, when all these green people were pushing the hell out of EVs and everyone said it was going to be an EV world, Toyota was the only one who said it doesn't work. It's not going to work. And the head of Toyota at that point, they kicked him out on his ass, and they brought him back later because he proved to be right, and they're now the leader in hybrids. So goes to show. For Cooper Standard, hybrids are the sweet spot, carrying 80% more content per vehicle than comparable ICE platform. EVs are accretive too, though to a lesser extent, at 20% higher cost per vehicle than ICEs. That mix shift is already showing up in the order book, with 74% of 2025 new business wins tied to battery electric or hybrid platforms, and 28% of first half new business awards split roughly 50-50 between the two. Okay, powertrain. So you can see 70% of new business wins tied to battery electric or hybrid platforms, 28% of first half new business split 50-50. So the cost per vehicle in hybrid plus 80%, in electric plus 20%. Our whole thesis of getting back to over $8 of earnings and to $10 of earnings was predicated on ICEs, and the tailwinds are coming from hybrids, which has been a pleasant, unexpected surprise. And that's why they're hitting their numbers so much sooner than we hit peak volumes for the cycle. We're nowhere near peak volumes for the cycle, which is why, when it was $146 stock, they were earning $7.19 in 2017, on more than 17 million of volumes. We're at 16 million. And the operating leverage is huge, which is why we think even if it was all ICEs, they could earn $10. With hybrids, they could even earn more. The key will be, do they get a 10 times multiple and it's $100 stock, or do they get a 20 times multiple like they got back in 2017 at the peak and it's a $200 stock, and time will tell. But ticking along according to plan, thanks to incredible management and some composition tailwinds, not volume tailwinds yet. We're going to get those next. None of this was part of our original underwriting. The thesis centered on a recovery in North America ICE production volumes, with growing hybrid trend only showing up afterward as a free flyer and quickly becoming one of the strongest tailwinds the company has going for it. Third, and why we expect some solid upside in Cooper Standard's full year's figures, is the writing on the wall for an F-150 production ramp in the second half. While Ford is by far Cooper Standard's largest customer at 27% of revenue, the F-150 is its single most valuable platform, carrying $450 of cost per vehicle versus $190 on the average across the top 10 platforms, and an estimated 10% of overall company sales. That concentration worked against Cooper Standard last year when the Novelis fire idled 40% of North American sheet aluminum supply and halted F-150 production, a disruption that carried into the first half of this year. That is now behind them, and everything coming out of Ford management points toward a significant production ramp in the back half. F-150 retail day supply exited the second quarter at 52, below Ford's target range of 55 to 65, with the rebuild toward those levels expected as the recovery progresses. Between making up the 100,000 units lost to Novelis disruption and the 50,000 planned growth layered on top, the math puts F-150 production 150,000 units above 2025 levels, with the bulk of it landing in the back half. On top of that sits the Oakville expansion, which adds 100,000 units of incremental Super Duty capacity and remains on track to launch in the fourth quarter. As Ford put it, quote, "You've got the Super Duty and you have the F-Series that are going to be coming back in full force for the second half of the year. None of this incremental production is reflected in Cooper Standard's guidance." Management was direct on the call, saying they are hoping for a 20% uplift in the second half versus the first, but have not yet seen it show up in the releases. And as management put it, quote, "If it doesn't show up in the release, it doesn't go in the forecast." In other words, investors get a free option on incremental production and the earnings upside that comes with it, on top of a guide the company already has strong visibility into reaching. Keep in mind, all of this is happening before overall volumes have even started to help. Let's get that chart up. New car sales in 2026 by OEM model and vehicle type. So you can see that there. July SAAR came in at 16.3 million, down 1.4% year over year, with the year-to-date pace at 16 million, down 2.2%. Encouragingly, Ford continues to assume U.S. SAAR of 16 million to 16.5 million units, while GM is baking in the low of 16 million unit range, suggesting a potential back half sales acceleration. The bigger point is that every basis point of margin progress at this company over the past handful of years has been self-generated with zero assistance from the cycle. The good news is that the structural case only gets stronger the longer this goes on, with key catalysts including an all-time high average vehicle age of 14.5 years, the strongest licensed driver growth in more than 40 years, 70 million plus millennials moving through their prime vehicle ownership and family formation years, inventories to sales still well below historical averages, and every U.S. auto cycle going back to 1970s peaking between 17 million and 17.8 million SAAR, 17 million and 18 million SAAR, when the population was 30% smaller. The beach ball can only stay underwater for so long. Bottom line, we continue to believe Cooper Standard's best days are ahead. The market is focused on 1 quarter of temporary input cost noise, while the company's most important long-term drivers are moving decisively in the other direction. New business is accelerating, hybrids are becoming increasingly important part of the mix, and F-150 production is poised to recover. Put it all together, and the path to $10 plus of earnings power is not only fully intact, but increasingly starting to look conservative. So you can see the Q2 earnings breakdown. We've covered all the key points from the deck, from the earnings call, etc. So you can go through this at hedgefundtips.com and so on. Stiefel upgraded it with a $53 price target. Baxter update. This thing has doubled off the lows. For newer readers, here's a quick overview on the key drivers behind our thesis on Baxter, a century-old med tech leader where temporary headwinds and operational missteps have created an opportunity for Danaher Trade's CEO to reset execution and restore normalized earnings power. We've highlighted all the key points from the earnings results, from the deck, and from the call. You can find it at hedgefundtips.com. 10 key points. Revenue was up 5% year on year, came in ahead of consensus. Adjusted gross margin, 38.6%. Adjusted EPS was 56 cents, down 5% year on year, came well ahead of consensus at 37. One-time IEPA backed out, still leaving clear beat of 22%. The decline was expected, driven by same higher cost inventory and prior year cost timing headwinds that pressured margins. Medical products and therapies revenue of 2.08 grew 7% and 5% organic. Healthcare systems and technologies. By the way, go to hedgefundtips.com, read this in detail. If we go through this whole thing, we'll be here for 4 hours, but you definitely want to get all the details. Healthcare systems and technologies up 4%. Baxter has identified corrections to address the Novum IQ field actions and is now in early verification testing, a step forward from last quarter when corrections were still being finalized. Free cash flow of $181 million in the quarter was up 135% year on year from 77. Deleveraging remains the top near-term capital allocation priority, with the first half cash generation giving management increased confidence in hitting its 3 times net leverage target by year end while maintaining investment grade rating. 9, now in its third quarter since development, growth and performance system, GPS, is becoming embedded in how each division operates, with over 400 continuous improvement events completed in the first half. 10, management raised the full year outlook across the board, with reported sales growth now expected at 3 to 4% from flat to 1%, organic sales growth at 2% to 3% from flat, and adjusted EPS at 195 to 215 from 185 to 205, putting the new midpoint at 205 against consensus 191. By segment, MPT moves to low single-digit organic growth from flat on stronger year-to-date performance, including drug compounding, with HST held at low single-digit growth, supported by care and connectivity solutions and frontline care. So we covered all those details here. And fear and greed now at 65, so a little bit greedy, and so on. Next, healthcare top 30 weights. Earnings estimates revised up 1.68% for this year, 1.52% for next year. Financials top 30 weights revised up 6.31% for this year, 3.22% for next year. That's in the last 60 days. Insider buying in Pfizer. You had $2 million of buying from the board. And by the way, today, the CEO bought $1 million of stock. We posted on X. Go to X and follow at Hedge Fund Tips. Inflation came in lower than expected this week. PPI came in a lot lower. Core PPI. So these were good signs. CPI in line with expectations. But PPI is the leading indicator. So that's been positive despite all the Iran situation. Earnings growth has been great. You back out other income, which is the mark to market, still great. Very similar to Q4 of 2021, which we have covered. And now on to our Ask Me Anything questions from our incredible audience. We are grateful for your support and your brilliant questions. And let's start with Loam Van Dam is asking, can we get your opinion on 10-cent at these levels? And I think the whole China big tech basket is a buy here, but we'd be buyers of Alibaba over 10-cent at these levels. But I think it's a great business at I think it's a good business at a good price. We like good businesses at great prices. Let's move to Danny Diaz. VER, longtime listener, first time caller. Thank you for your support. VERX. Okay, so this has been public for about 6 years. What do they do? Yeah, this is the thing that concerns me. It looks like a lot of stock-based comp, but let's take a look. Enterprise tax technology solutions for retail trade, wholesale trade, manufacturing industries, transaction determination, compliance reporting, workflow management tools, tax data management solutions, pre-built mapping fields, business logic and integration, technology, e-commerce, So this is in the payment services, so that the group is down in the short term. This is also software, which I think is a little bit challenging. So you just have to understand what the competition is. From the numbers exclusively, not making a qualitative determination of its positioning and its moat relative to peers and being disintermediated by other software, it looks great. From a competitive standpoint, that's where the work begins. So I would suggest if you're going to do anything here, you better know what its possibilities of being disintermediated are and what the competitive landscape looks like. But on a numbers exclusive basis, I think you've certainly got something here that warrants doing the research and potentially moving ahead. So good work on that. Panos and great podcast last week as usual. Acilar Luxottica ESL. This is a consumer play, so let's take a look. I think there's a Pink Sheets version. No. Okay. ESL. All right. Cash flow has been flat for 4 years. Revenues have been growing more slowly. And what are their brands? Oh, this is the eyeglass company. Ray-Bans, blah, blah, blah. Yeah, they kind of have a moat in the business. I do like this one. I don't think it's something that we would put in the portfolio, but I don't think you're going to get hurt doing this. 295 down to 165. Yeah, margins. So I would just start to understand what are they doing about reaccelerating margins. But that said, I think you're buying this thing at a decent discount. I think it's a good business at a so-so price. So I think you'll do okay with this one over time. Jason Zen, ERII, Energy Recovery Inc. What do they do? Designs, manufactures, and sells energy efficiency technology solutions. Operates through water and emerging technology, high and low pressure, ultra pressure exchangers, cold storage facility, supermarket chains, blah, blah, blah. I kind of like this. I would, yeah, I think this is pretty interesting. It's certainly worth doing some work. It's a so-so business at a pretty good price. So definitely worth writing down and doing some further research. So good job there, Jason Zen. Cork Snyder, hey buddy. 25-year-old daughter is looking for a condo or home to purchase in Orange County, your home county. Any thoughts on the health of the housing market in OC and broader, and whether or not she should wait or buy? Price point 800 to 900K. I don't know, man. I thought I bought the top. Everything keeps going higher in Orange County housing. But I will say, all these housing cycles start in at the fringes in Florida and Texas, and you're seeing a lot of weakening there. In areas like Austin and parts of Florida that are not called Miami or Palm Beach. Orange County is such a unique beast. I don't have a view. I mean, I think it goes in the too hard box. Thank God I don't have to speculate on real estate prices or I'd be in trouble. But, my general view was, when we bought here in Newport, was like, wait a couple years, this will come off the boil, and it probably will. But by then the girls would be 16 and 14 and they wouldn't be able to enjoy it. And we're here for the sports. So, it's not an investment. It's just accepting the loss and in money and the gain in familial happiness and self-actualization for my daughters. So, as far as your daughter goes, I mean, she's got a long time ahead. So even if it weakens, at that price point, 800 to 900, like what's the worst case scenario? It goes to 650 before it goes to 1.5. Or you could blow a year or two on rent and maybe buy it $100,000 yet less. I think if you're going to buy now, look for an ugly duckling that you can throw some paint on and that you do some work to, so you can kind of hedge the value and the price. So less capital outlay, more labor, which is a good formula at that age, versus buying something that she can turn the key in. It's beautiful because someone already juiced the value out of that, which is super common. It was funny being out in the Hamptons, just seeing the difference. Like, in Newport, you can buy a shack for $5 million. In the Hamptons, you can buy a mansion. And you look out there and it's shocking. Like, every piece of dirt in Orange County is optimized. All these old houses have been either bulldozed and rebuilt or completely redone. Whereas on the East Coast, they just, keep them the same forever. Like, you don't see the same level of upgrading because I guess the dirt is not as valuable, or every inch of dirt is not as valuable as is in Orange County. So the answer is, if she's taking the long view, and she has a short-term mark-to-market loss, it's not an investment because she's going to live in there. But if she doesn't want to rent for a year or two to kind of see if things soften, I would say find an ugly duckling that requires a lot of work. So at least she gets a discount that she can then realize full value and be a little insulated from short-term mark-to-market, is an amateur's advice on Orange County real estate. And all the Orange County people listening are laughing their asses off right now, saying, Tom, you schmuck, real estate prices in Orange County only go up. So time will tell. RDA, I hope they're right. I'm super long. I got 2 houses in Orange County. One that we bought when we first came out here, that we're now renting out, and the new one. So I hope they're all right. RDA, hey, thanks for your insights. Can you take a look at SIGA, SIGA? And kudos to Cork. He got us an incredible tutor, Claire, who's now at MIT, for our daughter in math. She was phenomenal. And that's that. All right. SIGA. I don't see it. Revenues are going nowhere. Free cash flow is negative. What do they do? commercial stage pharmaceuticals. So you're betting on a drug approval. That's not what we do here. That's, guessing and gambling unless you have some edge. In which case you probably shouldn't own it anyway, because that's not the way to do things. Adam R, take a look at OI. Yeah, I think I like this one. Let's take a look at the numbers. Wow, what is going on here? This is the lowest quality revenue profile I've seen. Super cyclical. I think this is a trade, and I think it probably wind up with a double, but is a really low quality business. We wouldn't do it because we're not confident in the fundamentals, but I think it'll work from a trading standpoint. SIDM 401 now allowing stocks, bonds, ETFs. Nice not to be limited, but curious on your thoughts. Long-time listener. I don't know your financial situation. You got to go through that with your financial advisor. Ryan Ferrari. Have two general questions. First, when you are screening for stocks, what are you filtering for? We're most people are looking for all-time highs. We like all-time lows, or near all-time lows. We like things that have been beaten down in price, but not in fundamentals. As far as capital allocation, it depends on the industry. There's no hard and fast rule. The type of companies that we buy, which have been around usually for decades and have predictable, durable cash flows, we're getting growth-like returns with value-like risk, because we're buying it down so much that we can get doubles or triples in a few years, which is normally what you would see in a growth stock, but you're not taking the risk because in a growth stock, the multiples are so high and the predictability is not nearly as much as a company's been doing it for decades, that you can get smashed, whereas the value ones, all the bad news is priced in. We like all the bad news priced in and a free option on the normalization, which can give us, 2 and 3 baggers over a few years. So look for things that are beaten down in price and not in relative fundamentals. Jose Perez, following great interest your videos every week. Thank you very much indeed. Hope you enjoyed Paris and Versailles. Next time I'd recommend you go to Madrid. We did that already. We love it. Very great. Plenty of Museos del Jamón in Madrid. View on Goose is fine. Nothing's changed. Fundamentals continue to improve. There's some tariff issues, but the brand is strong and hasn't even seen the beginning of real recovery in Asia, where they have a stronghold. We like the Goose, and we're seeing more and more people wearing the T-shirts and the hats and the 24/7 365 theme, and execution is playing out. Boise Cascade, I think you're a little late on this. I know it's pulled back, but I just tend to avoid stocks that have already had 10 baggers and you're buying on the way down. So could it bounce from here? Yes, but it's not where we want to be allocating capital. Willis Gear, avid listener for 3 years. Thank you. Share your podcast with people constantly. Thank you. That's why we keep doing it for you. Interested in your thoughts on GEOS. I think I know this name from a while back. No, probably not. Yeah, so this is a trading vehicle. It's a cash flow negative business. We don't like it. And let's just see, it's probably in space or something, so everyone's getting excited. Oh, oil and gas industry, seismic data. Yeah, this is the servicers. We own National Oil, well, Varco, NOV. We like that better. It's higher quality. I think you want to go NOV or Schlumberger or something in that ilk versus this. That said, I don't like the fundamentals on this, but I think on a trading basis, you're going to be right, and you could probably make a double, but I couldn't do that with confidence because the fundamentals are no bueno. Can you check PNR? I think the secular fundamentals are great. PNR, this is interesting. Various water solutions, fluid treatment, interesting. Yeah, I think that one's interesting. You have to accept it could go down to 50 before it goes back to 120, but I think that's pretty good, Bob. Nice work. PNR, worth writing down. I think for me, I'm going to wait till see if we can get it at 50. I mean, I don't know if that'll ever be a position or not, but that's how I would think about it. I think you can certainly buy it here and take the long view and be fine, and you may never see it at 50. EFOR, but like I always say, when God was handing out FOMO genes, he missed Tom Hayes. I don't care if I miss it. There are plenty of opportunities all the time. EFO4, it's already doubled off the bottom, but probably going higher. Let's just see if that's confirmed. And certainly on a trading basis, that is correct. IT solutions for commercial and government sectors. Consulting, digital marketing, permanent placement. Yeah, not really business I want to be in, but I think this will continue to work higher over time. Thanks, Martin. Vicky Singh. Yeah, we keep a concentrated book. So the reason we run separately managed accounts for clients is because we put them in those stocks that we think are just leaving the station, not already cruising at 30,000 feet. So she's saying, you talk about 8 to 12 stocks, but you have a universe at 15 or whatever it is. And that's because some are getting close to being exited, and others, which we would not be putting new clients in because the IRR is going to be diminished. Most of the juice has already been squeezed. And putting them in those things that we think are just leaving the station. So yeah, good question there. Thoughts on pizza earnings? Look, the good news is they don't sell lettuce, Papa John's. The bad news is it was a bit of a shit show. And we did take the weakness as an opportunity to add. I wouldn't say we were buying till our fingers bled, but we did add to the position after the sell-off. I think we're, here since day one, it's been a bet on Todd Penegor. And Todd did turn around Wendy's. If you think Papa John's is a train wreck, you should have seen what Wendy's looked like before Todd came in and executed his turnaround. And it's further evidence to the fact that after he turned it around and had a multi-bagger in Wendy's, as soon as he left, the thing rolled back over under new management. So I think he's going to turn this thing. It will either eventually be sold as the climate changes, but it's a great play on the K-shaped recovery, because even McDonald's, if you go, you're going to spend $100 for a family or $80 for pizza. You can feed a family of 4 for $50, and it's good value. They're getting the app, they're getting the rewards. International is growing. People still are eating pizza, which is, people say, oh, no one eats pizza. No, it's just they have more competition from the C-stores, the gas stations, and the Uber Eats, whereas you used to, like, if you wanted to have something delivered, you could only do pizza. Now you can do anything, but they'll continue to lean into the value proposition. I liked what they said on the call. I actually listened to it on the plane versus Reddit. I wanted to get a sense of his, kind of emotion and conviction. And he's taking all the right steps in terms of defranchising, in terms of everything that he said. And I do think he will turn it. And I do want to have exposure to consumer discretionary and to the restaurants. We chose this one. Could you make a case for, well, why don't you just blow out of Papa John's and buy Chipotle? And the answer is, yeah, you could make a case for that. I think Chipotle is a better quality business, but they're going to be dealing with the lettuce issue, and now it's supposedly in jalapenos and guac, and that's just something that I wouldn't mind avoiding. And I like the margin of safety with Papa John's. We saw this exact cycle in 2016. So if everyone thinks, it's the end of Papa John's, let's just take a look at the facts, and we'll cover this one in coming weeks. We like to focus on the ones that aren't working versus the ones that are working. But you could see here, pretty normal cycle. You had this peak aberration in 2022 when people were paid home to sit home and eat pizza. But right before COVID was another trough cycle where the free cash flow and revenues were even lower than they are today, but the stock price was higher than it is today. It was in the 40s with negative or zero free cash flow and lower revenues. It's in the 20s today with positive free cash flow and higher revenues. Revenues are higher by about 20%. And then you got to go back to 2013. So every 7 years, you have these trough cycles for Papa John's for some reason. From 2013 trough to 2020 trough to 2027 trough, 2026 trough. So about 7 years. And then prior to that, you had it in 2008 trough. And then before that, you had it in the 2005 trough. And then before that, you had it in the 2000 trough. So it seems when everyone is excited about tech, at the peak of tech, no one wants to eat pizza because they're all eating caviar. And then when the NASDAQ crashes 80%, they all start eating pizza again. So this is another way to hedge the overcrowded semiconductor trade. When they lose their money and blow up their accounts on over-leveraged bets on one-way bets on overvalued sectors, they will then be forced to eat pizza and potentially Michelin-starred pan pizza at that. So we stick with it. It hasn't been fun, but we brought our basis down, and we'll hang through this on those two themes. Ilan Oliveras, Jensen Wong, put GPUs. All right, so here's some guy that's buying the top in semis and trying to make a case why I'm going to be wrong. I hope I'm wrong because it means everything else keeps going up. But I think you're going to be surprised with what happens in coming months. Edgard, just like you were in July. Edward Abreu. By the way, the comment from this person would be, this is a person who likely bought the top in June, sold out at the bottom of July, and is now buying the dead cat bounce in August and trying to convince themselves that they're right. And it just doesn't work out. And it's just, that's the process that you have to go through as an investor. It's the price of tuition. There's nothing wrong with it. Just acknowledge you're making decisions on the basis of emotions versus fact. Next is Alan Agarwal. Truly amazing video cast. Very big fan. Recommend you widely. Love it, Alan. Thank you very much, Alan Agrawal. Landscape. Yeah, so you can see here, he's asking about the overall hedge fund landscape. As you can see, a lot of them got shellacked in July. All of you who are listening, who have accounts, you know that July was one of our best months we've ever seen. So that tells you everything you need to know. But good question. Let's see here. Okay, here's a guy for client stuff. Jason M. Covered that. And Papa John's. I knew we'd get a few questions on that. Oh, Clay asks, what does Clay ask? Oh, SLVYY. Clay is an awesome golfer out of Palm Beach. Hope to play with you in the new year when I go down there. Specialty chem out of Solvay. SOLVAY. All right, so the stock's down a third, but your revenues are down 60%. Your margins are contracting. Share count is elevated and not going down. Free cash flow is down 70%, and the stock price is only down a third. So I think that there's potentially more downside here. There's not any evidence of a recovery in fundamentals. I've never seen revenues drop like to this magnitude. This I would take a decent look at if it was trading at 10 or 15, but not at 26. So for that reason, I'm going to pass. Certainly good question in terms of like price is down, but the fundamentals are down even worse. We like things where the price is down and the fundamentals are barely down, if not improving, like was the case with Baba at 80. And then BR from Matthew Tombaugh. That's NN Inc. I don't see any improvement. I mean, revenues have basically been in a free fall for a decade. What do they do? This is a cheap for a reason stock. Mobile solutions and power solutions. Not for us. And I think, oh no, we got more. Wow. More and more and more. Okay. All right, here's from June. Thank you for the video message. I'd like to send video messages when people order the merch and just thank them for doing it. And he says, can't wait to drink coffee with the new mug and watch for another 2 or 3 bagger. I love it, June. Super. Okay, and thank you for your support. Alejandro Capri, similar story to VF Corp. CPRI. This is from Alejandro Bustamante. Yeah, I mean, this one is showing. Yeah, I don't like this one as much. I have looked at it when we made the decision to go into VF Corp. I think it'll be okay. What are the brands here again? Michael Kors and Jimmy Choo. Yeah, I've never liked this one, but I see why you're getting interested at these levels. Let me just see here. I mean, this is just a huge drop, though, in revenues. I get really worried when revenues are dropping this dramatically. It looks like it's secular versus cyclical. 5.6 billion down to 3.4. It did inflect from cash flow negative. They did bring the share count. I think you're probably okay with this. I just don't know the brands well enough, but I think it's worth doing more research. VF Corp and Comstock, yes, we have added to those positions in recent weeks. Copart, this is from William. We like this. We've been doing some work on it. We haven't done anything with it yet. Jet Zero Z4, that's a long way off, certainly, and they might get bought. Okay. And that's that. So with that said, I want to thank everyone for tuning in. We'll be back next week, same time, same place. In the meantime, make it a great one. Bye for now. Pause your video player to review our terms and disclaimer. The material in this video has no regard to the specific investment objectives, financial situation, or particular needs of any viewer. This video is presented solely for informational purposes and is not to be construed as a solicitation or an offer to buy or sell any securities or any related financial instruments, nor should any of its content be taken as investment advice. Any opinions expressed in this video are subject to change without notice, and Great Hill Capital LLC or PPI is not under any obligation to update or keep current the information contained herein. Great Hill Capital LLC or PPI and its respective officers and associates or clients may have an interest in the securities, derivatives, or entities referred to in this material. Great Hill Capital LLC or PPI accepts no liability whatsoever for any loss or damage of any kind arising out of the use of all or any part of this material. We recommend that you consult with a licensed and qualified professional before making any investment decision.